So very good morning everyone. Today the chapter which we have to discuss is gross total incomes deduction. That means deductions from gross total income. So friends, tell me, what do you mean by gross total income? Gross total income simply means you compute the income from each heads. You compute income from salary, house property, PGBP, capital gain, IFRS. Then you add it together. That added figure is called as what? Gross total income. While computing gross total income, two things you have to consider. Number one, that is clubbing provisions. And number two, it is set off and carry forward. What is clubbing and set off and carry forward? We will discuss. Alright. So for the time being, while computing gross total income, it is subjected to clubbing as well as set off and carry forward. That's what I have to say. Now, let's discuss each and every chapter 6A deductions in detail. To start with, first thing that you should know, chapter 6A deduction, by making use of chapter 6A deduction, we can never end up in loss. What do you mean by making use of chapter 6A deduction, you can never end up in loss means? See, maximum chapter 6A deduction shall be subjected to the gross total income. Say for example, your gross total income is 1 lakh. Maximum chapter 6A deduction will be 1 lakh. You cannot claim 1,20,000 as chapter 6A deduction and claim loss. It is not possible. Chapter 6A deduction is always subjected to the gross total income. You cannot claim 6A deduction over and above your gross total income. Now let's understand which all are the sections that comes under chapter 6A. To start with, the first one is ATC. So please write along with me. Section ATC. We have a lot of items under ATC to discuss. So right now I am only focusing on those important items under ATC because it is around 20 to 23 items are there. So we will consider most of the items. Alright, I will skip a few of them. So let's start with the ATC deduction first. ATC is called as section ATC is called as deduction in respect of investments. Deductions in respect of investments. So let's understand what exactly is ATC, that is deduction in respect of investments. So you make certain investment, you will get that as a deduction. Are you all listening? You make some investments and take it as a deduction. So let's understand which all are the items that comes under ATC. So item number 1 under ATC is premium paid for life insurance. Premium paid for life insurance of a particular person. That is the first adjustment or first deduction under ATC that we have to discuss. Premium paid in respect of life insurance. So friends, what do you mean by life insurance? Say for example, you have taken up insurance on your life. If something happens to you, say like a death or incapacitation, you will get a compensation. If it's a death, then your legal heirs will get a compensation, a lump sum amount from the insurance company due to your loss. So let's understand the concept here. So when you take an insurance, you must pay the premium. Yes or no? When you take an insurance, you must pay what? Premium. That premium is allowable as a deduction from your income taxable under Income Tax Act. You can claim it as a general deduction, not under any head. It is a common deduction. So the first item here is premium paid for life insurance. Now, a person can take life insurance or for his life, his spouse's life, and for his children's life. Yes or no? So all the premium paid in respect of individual, spouse, and children are allowed as a deduction. But there is a problem. If you have taken any insurance for your brother, sister, parents, etc., it is never allowed as a deduction. So what we can say is premium paid for the life of individual bar spouse bar children allowed as deduction. Allowed as deduction. If you have paid any premium for the life of your parents, you will never get it as a deduction, whether parents depends upon you or not. See, if children is minor or major, doesn't matter, you will get the deduction always. But your parent, you will never get it as deduction, even if the parent is depending upon you. Whether the parent depends upon you or not, you will never get it as a deduction. That's what the department says. I hope this much is clear. So, that's all about premium paid in respect of life insurance. Now, there are a few certain ceiling limits that you should know. So, let's understand the ceiling limits. You cannot claim the entire premium paid as a deduction. There are certain ceiling limits. So, let's understand which all are the ceiling limits that comes in. Starting with the first one, if policy issued on or before 31st March 2012. If the policy is issued on or before 31st March 2012, how much is the deduction? Department say premium paid up to 20% of sum assured. Premium paid up to 20% of sum assured allowed as deduction. Allowed as deduction. What do you mean by this? What do you mean by sum assured? We have used a word here that is sum assured. What do you mean by sum assured? Say for example, you have taken a policy. You have taken a policy, and then at the maturity of the policy, say maybe the policy for 5 years or 10 years or something. At the maturity of the policy, the insurance company will pay you a lump sum amount, and that lump sum amount is called as what? Sum assured. If nothing happens to your life, say for example, there is no death, there is no incapacity and all, at the end of the premium period, you will get a lump sum amount. That lump sum amount is called as what? Sum assured. I hope it is clear. Now friends, listen. If policy issued on or before 31st March 2012, then your premium amount up to 20% of sum assured is allowed as a deduction. That's what the department say. If your premium amount is over and above sum assured, that excess will never claim as a deduction. Maximum up to 20%. Moving on. If policy is taken, if policy issued after 31st March 2012, the policy is issued after 31st March 2012, then the department say premium paid up to 10% of sum assured. Premium paid up to 10% of sum assured is allowed as a deduction. Up to 10% of sum assured, it is allowed as a deduction. Your premium paid up to 10% of sum assured is allowed as a deduction if the policy is on or after 31st March 2012. They have revised the 20 into 10, provided the policy is taken on or after 31st March 2012. I hope you are listening. Now there is one more item they have provided. What they are saying is, if policy issued on or after 1st April 2013, if the policy is issued on or after 1st April 2013 plus insurance is for a person having disability. Insurance is for a person having disability or person suffering from prescribed disease. So what they are saying is, you have taken an insurance policy. First, the date. What is the date of the policy? It should be on or after 1st April 2013. And the policy is actually taken for a person having a disability. What do you mean by disability? A person having any problem with his legs, hands, etc. called as a disabled person. Yes or no? A person having a disability or a person suffering from prescribed disease, you have taken a policy. In such case, department say they are coming up with a higher limit, that is premium paid up to 15% of sum assured. It is not 18, it is 15, okay? 15% of sum assured. allowed as deduction. Allowed as deduction. That's what the department says. Now listen, these are the three limits that you should study under 80C. First item, premium on life insurance. I hope you all are listening. Now listen friends, if the policy is taken on or before 1st April 2012, so before 1st April 2012, that means on or before 31st March 2012, premium paid up to 20% of the sum assured is allowed as a reduction. There is no other condition, nothing. Alright. Now, if the policy is issued after 31st March 2012, then premium made up to 10% of the sum assured is allowed as a reduction. If the policy is issued after 1st April 2013 and the policy is taken for the life of a person having a disability or person having prescribed diseases, then you can claim 15% of the sum assured as a deduction. So, these are the three limits that you should understand under 80C premium for life insurance. I hope this much is clear. So, friends, let's solve a problem. Please take your page number 35. Page number 35, question number 1 under chapter 6A reduction. It is in relation to life insurance policy premium. Page number 35, question number 1. So, I hope you have completed the question. Anyways, let's solve it together, friends. Listen. So, what they are saying is, compute the eligible deduction under 80C for assessment year 23-24 in respect of life insurance premium paid by Mr. Ganesh during 22-23. The details of which are given here under. So, the first one is date of issue of policy on 30th March 2012. So, the policy is issued before 31st March 2012. It is for self. Self means for himself. Now, actual capital sum assured. The sum assured is 6 lakhs. Now, insurance premium paid during 22-23 is 51,000. How much you will get it as a deduction? That is a question they are asking. As you know, what is the maximum deduction available? 6 lakhs into 20% since the policy is taken on or before 31st March 2012. How much is 20% on 6 lakhs? 1 lakh 20,000. How much is the actual premium? 51,000. So that entire 51,000 is allowed as a deduction. Second one, the policy is taken after 31st March 2012. That means up to 10%. If it is for disabled, then 15% you will get. Now it is taken for the spouse. So 1,50,000 into 10% the maximum deduction. How much is the maximum deduction? 15,000. And the premium that you are paying is 20. You will never get 20 as a deduction. Maximum deduction shall be 15,000 rupees. Now 1st June 2020. That means it is after 1st April 2013. And it is taken for the handicapped son. Then how much is the reduction? Up to 15% is allowed as a deduction. How much is 15% on 4 lakh? 60,000. How much is your actual is 80. You will never get that. 60 will be your deduction. So tell me how much is the total coming? 1 lakh 26,000 is the total figure coming. Now friends, 80C deduction in total shall never exceed 1,50,000. There is a condition that we will discuss it later. Total 80C deduction shall never go beyond 1,50,000. That we will discuss later. I hope this much is clear. Now moving on friends. Alright. So let's move on with the second item under 80C. So let's understand what exactly is the next deduction under 80C. So please write along with me. So deduction number 2. Deduction number 2, that is premium paid. Premium paid in respect of a contract for deferred annuity on life of individual or spouse or child. Children, we can write children. Maximum deduction shall be maximum deduction shall be 1/5 of 1/5 of salary. Maximum deduction shall be 1/5 of salary. All right. So the point is, friends, what do you mean by this deferred annuity? What is deferred annuity? Say, for example, annuity means an annual sum. That's it. Deferred annuity means it is just like a savings. Just like a savings, if you, for yourself or for your spouse or for your children, you are paying some premium, just like an investment, and in future you are getting a lump sum amount. That future is said to be deferred. Annuity means lump sum amount. Annual sum is said to be annuity. All right. Just like an approved investment fund, if you are investing in this and in future you are getting a lump sum amount, this premium that you are paying every year is allowed as a deduction, provided maximum deduction shall be 1/5 of the salary. Not that very important, but it is there. Moving on to the third deduction under ATC. Third item under ATC, that is contribution to SPF bar PPF bar RPF. What is SPF? Statutory Provident Fund. What is PPF? Public Provident Fund. What is RPF? Recognized Provident Fund. If the employee himself is contributing to SPF, PPF or RPF, that contribution is allowed as a deduction under ATC. Hope you remember, in salary chapter, I have referred it. Employee contribution is subjected to ATC deduction. That's what this is all about. So, if you are contributing to SPF, PPF and RPF, deduction shall be allowed under ATC, and maximum deduction here. Maximum deduction here is rupees 1,50,000. Maximum deduction for this contribution alone shall be 1,50,000, and there is one more overall ceiling limit. Total ATC, all items deduction shall never go beyond 1,50,000. Now, point number 4. Point number 4. Any sum deposited in Sukanya Samriddhi account. Sukanya Samriddhi account. Sukanya Samriddhi account. What is Sukanya Samriddhi account? It is for the betterment of your girl child. Central government has introduced a scheme called Sukanya Samriddhi account. So the main purpose is, say for example, if you are an individual and you have a girl child and you are depositing some amount for the future education and other expenses of the girl child, the amount you are depositing in Sukanya Samriddhi account is allowed as a deduction. Are you all listening? If you are an individual and you have a girl child and you are investing for the future of that particular girl child, then that amount that you have invested in this Sukanya Samriddhi account is allowed as a deduction. That's it. For girl child, we can say. Then point number 5. Let's understand what is point number 5. It's an important one. Subscription to National Savings Certificate. Subscription to National Savings Certificate. So friends, what do you mean by National Saving Certificate? Say for example, it's an investment scheme. If you are investing, just like an FD, if you are investing in this National Saving Certificate, which is promoted by central government, then the amount that you are investing in this NSC is allowed as a deduction. It is again for the purpose of promoting investment. They are saying National Savings Certificate, introduced by the central government. You are investing in that, you will get the amount invested as a deduction, subject to the overall ceiling limit under ATC. What is the overall ceiling limit? Maximum deduction altogether shall never go beyond 1,50,000. Now moving on with the next item, friends, that is investment in, item number 6. Investment in unit linked insurance plan. Investment in unit linked insurance plan of LIC mutual fund. LIC mutual fund. To promote the LIC's unit linked insurance plan, government has given another advantage. You invest in LIC's ULIP, you will get that invested amount as a deduction. To promote LIC, the government is saying you invest in LIC's ULIP, you will get that investment amount as a deduction. Then next is point number 7, contribution to approved annuity plan. Contribution to approved annuity plan of LIC. Say you are contributing to an approved annuity, that means an annual sum. Alright, approved annuity plan of LIC, that is also allowable as a deduction. Point number 8, contribution towards notified units of mutual fund or UTI. Say you are investing to the notified units of mutual fund and UTI. What do you mean by notified units of mutual fund and UTI? That means, say the government has notified certain mutual funds and UTI. You are investing to that particular notified mutual fund and UTI, then you will get that investment as a deduction. UTI means what? Unit trust of India's units. Now, moving on with the next item is item number 9. We'll write it here itself. Item number 9, which is an important item. So what they are saying is payment of tuition fees. Payment of tuition fees. Payment of tuition fees to college, school, etc. To college, school, etc. for full-time education. For full-time education. Full-time education for maximum 2 children. For maximum 2 children within India. Within India. So what do you mean by this, friends? Say for example, you are paying the school fees or the term fees or the college fees of your children. Alright, that fees paid by you is allowed as a deduction under 80C, but there is a restriction. Maximum up to 2 children's fees is allowed as a deduction. That too, the student or the children should study in India. If your children is studying abroad, then we have no plans to give you what? Deduction. We will not give you any deduction if your children is studying abroad. That's what the department says. Now again, listen, this deduction is only for the term fees, not for the other kind of donation. Say for example, a school normally charges establishment fee, festive fee, school uniform fee, school bag fee, celebration fee, summa fee. Yes or no? They will charge left and right by calling it as that, this silver jubilee fee, school swimming pool fee, gardener fee, everything fee. Okay, so everything they will charge. All those things you cannot claim it as a deduction. Whether to pay it or not, it's according to your wish. Alright. So if you pay it, you will never get it as a deduction. Only the term fees. That means the tuition fees. Tuition fees doesn't mean that private tuition, okay? Tuition fees means the academic school fees. That is only allowed as a deduction. Now, item number 10. Item number 10. What it says is repayment of housing loan. Repayment of principal portion. Repayment of principal portion of housing loan. Repayment of principal portion of a housing loan includes Stamp duty charges. Stamp duty charges includes stamp duty charges. Include stamp duty charges and registration fee. And registration fee. So hope you remember. Yesterday, I think while solving PGBP question, I have given you, last session, when we solved that PGBP question, I have given you a hint. When you are repaying principal portion of your housing loan, that principal portion that you have repaid is allowed as a deduction under 80C. So, two advantages you have when you take a housing loan. Number one, the interest on housing loan is allowed as a deduction under house property, 24B. Now the principal repayment of a housing loan again is allowed as a deduction under 80C. It's totally advantage for you. Both the principal portion as well as the interest portion, you can claim it as a deduction. Are you all listening? So that's what the department says. Now let's move on. And it includes stamp duty charges that you have paid. What is stamp duty charges? At the time of registration of the new house, you must pay stamp duty charges and registration fees. Both can be allowed as a deduction under 80C. Point number 11. Point number 11. Investment in 5-year term deposit. Investment in 5-year term deposit. What do you mean by 5-year term deposit, friends? Say for example, with a scheduled bank, we can write it in full. With scheduled bank, So what do you mean by a 5-year term deposit with a scheduled bank? Say for example, you are putting an FD, 5-year FD in a scheduled bank. That investment is allowed as a deduction under 80C. Again, it's a super offer. You only have to invest. It's not an expenditure basically. You put a 5-year FD in a scheduled bank. That amount is allowed as a deduction under 80C. Moving on with the next item, that is item number 12. Subscription to notified bonds issued by NABARD. Notified bonds issued by NABARD. What do you mean by subscriptions to notified bonds issued by NABARD? What is NABARD? National Apex Bank for Agriculture and Rural Development. Say you are investing in a notified bond which is issued by NABARD, then that investment is allowed as a deduction. That is item number 12. Then item number 13. Item number 13, investment in a 5-year post office time deposit. Investment in a 5-year post office term deposit. Investment in a 5-year post office term deposit. See, in post office, you can open savings bank account and you can put FDs also. So if you are putting a 5-year term deposit with the post office, then that is also allowable as a deduction under 80C. But nowadays nobody prefers that because they don't advertise or they don't communicate it with the people. But there is an option for everyone. With your post office, if you go, you can open a savings bank account over there and you can put FDs as well. They will give a decent rate of interest and decent rate of FD interest as well. Alright, now moving on with the next item, that is item number 14. So that is deposit in senior citizens savings scheme. Senior citizens savings scheme. What do you mean by deposits in senior citizen savings scheme? It's actually savings scheme introduced by the government for the senior citizen. If you are investing in that, that amount is allowed as a deduction. But the problem is, senior citizen, whether he will invest it over there or not is another question. Maybe he has some provident fund or gratuity excess of money with him. He might have invested. He will, maybe, we don't know. He might invest it. So this is not that general, what do you say, a scheme where lot of public takes initiative and all. But it is there. If you invest, you will collect it as a deduction under 80C. Now, item number 15. Contribution to additional account under NPS. Contribution to additional account under NPS. Under NPS for central government employees. For central government employees. In bracket write tier 2 account. Tier 2 account. I will explain what is NPS when we discuss 80CCD. For the time being, forget about this. So these are the 15 items that we have to study under 80C. Can you just go through these 15 items again by yourself? So friends, moving on with the next deduction, that is 80CCD deduction. That's what we are, 80CCC is there. Let's complete 80CCC, then we will move on to 80CCD. So please write the next deduction, that is under section 80CCC. So let's understand what all are the deductions under 80CCC. That is deduction for contribution to pension fund maintained by LIC under section 80CCC. Say for example, you have a pension fund which is made by Life Insurance Corporation of India and you are contributing to that particular pension fund, then you will get a deduction for that contribution under 80CCC. What do you mean by pension fund maintained by LIC? It's actually a pension fund, your retirement fund. If it is maintained by LIC and you are investing in that particular pension fund, you will get a pension after your retirement. It is not that employer-employee pension and all. It's a separate pension. If you want a pension from LIC, there are schemes under LIC. You can invest it. At the time, say for example, after certain age or after your retirement, you will get pension from Life Insurance Corporation. To promote this scheme, what government say, you go invest in this and take deduction under 80CCC. So that is 80CCC deduction. I hope it is also clear. There is nothing 80CCC. Now next we have to study a little bit, that is 80CCD. That is deduction for contribution to pension scheme notified by central government. So deduction to the pension scheme which is notified by central government. So let's understand, this is called as NPS, that is National Pension Scheme. So let's split this into different categories. Number one, for salaried person. For a salaried person, you can split this into two. That is for employee contribution and for employer contribution. What do you mean by employee contribution? To the pension fund, both employee as well as employer contributes. At the time of retirement of employee, that pension fund will make him a retirement benefit. Yes or no? So, for the employee contribution, he will get a deduction. He will contribute it from his monthly or annual salary. He will get that amount contributed as a deduction. And how to claim that deduction? You can split that also into two. This deduction, again, you can split it into two. Number one, under section 80 CCD subsection 1B. 80 CCD subsection 1B up to rupees 50,000 is allowed as a deduction. There is nothing, no condition, nothing. If your annual contribution is up to 50,000, you can straight away claim it as a deduction under 80 CCD. Are you all with me? CCD subsection 1B. If your actual contribution in a year exceeds 50,000, then up to 50,000 only you can claim it as a deduction. If it exceeds 50,000, then you have to compute deduction under section 80 CCD subsection 1, subjected to a ceiling limit that up to 10% of basic salary plus DA forms part of retirement benefit only is allowed as a reduction. Say, friends, listen, if your actual contribution exceeds 50,000, for the excess, if you want to claim any deduction, that you have to claim it under 80 CCD subsection 1. And under 80 CCD subsection 1, you cannot claim the entire excess. That excess is again subjected to a ceiling limit. What is the ceiling limit? 10% of your basic salary plus DA forms part of the retirement benefit is a maximum deduction under 80 CCD subsection 1. But the interesting factor is under 80 CCD 1B, there is no such ceiling limit. You can claim up to 50. If your actual contribution is over and above 50, that excess have to be dealt under 80 CCD subsection 1. And under 80 CCD subsection 1, the limit is basic plus DA of retirement benefits 10%. I hope it is clear. Now, it is not yet over. They are also saying one more restriction here, that the restriction is at say 80C deductions plus 80 CCC deduction plus 80 CCD subsection 1 deduction altogether should be always less than or equal to 1,50,000. This is the overall limit. See, we have completed 80C deductions. Yes or no? How much was the total 80C deduction? 1,50,000. 80 CCC we have covered. What was 80 CCC? LIC's pension fund. That you will get a deduction. There was no separate ceiling limit for that. Now 80 CCD subsection 1, you will get a deduction over and above 50,000, subjected to 10% of basic salary plus DA. That is allowable. But there is one more ceiling limit. That's a altogether, all the deductions under 80C plus 80 triple C plus 80 CCD subsection 1 shall be always less than or equal to 1,50,000. From which section, how much you have taken deduction, irrelevant. You add these three and say restricted to 1,50,000, bus. Are you with me? From 80C, how much you have taken? 80 triple C, how much you have taken? Irrelevant. What you need to do is overall deduction shall be maximum 1,50,000. That's what you are supposed to write in exam. Don't write 80C plus 80 triple C plus 80 CCD subsection 1 equal to 1,50,000 straight away. You need to compute it under each section, subject to their own ceiling limit. Or at the end of the working note or at the end of the question, you have to write maximum deduction shall be subjected to 1,50,000 rupees. Now, listen, for 80 CCD 1B, there is no such ceiling limit. That is the advantage. 80 CCD 1B is out of any ceiling limits. 50,000 you claim. You claim without checking anything else. Over and above has two ceiling limits. Number one, under 80 CCD subsection 1, that is basic plus DA, maximum 10%. Then overall ceiling under 80 CCE. This section is called as 80 CCE. Under section 80 CCE. 80 CCE states that 80C plus 80 triple C plus 80 CCD subsection 1 shall be less than or equal to 1,50,000. Now, let's move on to the employer's contribution. Now listen, this employer contribution is actually a cost for the employer. Yes or no? He can already claim it as a deduction under 36. PGPP, we have already covered that. Are you all listening? Now the point is, this employer contribution is first taxed as profit in lieu of salary in the hands of employee. The employer contribution is taxable as profit in lieu of salary. What is profit in lieu of salary? Just like salary, you have received something from your employer. That is said to be profit in lieu of salary. Just like salary, you have received something from your employer, some benefit from your employer. Now listen, when an employee receives this employer contribution to pension fund, that annual contribution is initially taxed in the hands of employee as salary. Thereafter, he is eligible to claim deduction. Now tell me, who can claim this employer contribution as a deduction? Who can claim this employer contribution as a deduction? For employer, under 36. For employee, initially it have to be treated as salary. Thereafter, you have to claim it as a deduction under 80 CCD. That's what we are about to discuss. So what department say? Under section 80 CCD subsection 2, up to 10% of basic plus DA form part of retirement benefit shall be the deduction. Under 80 CCD subsection 2, they say 10% of basic plus DA forms part of retirement benefit is allowed as a deduction. I hope that is also clear. Now, this is how you claim deduction under chapter 6A 80 CCD. You have to split it into employer contribution and the employee contribution. Now, listen friends, if your employer is central government or state government, if your employer is either central government or state government, then instead of this 10%, the limit shall be 14%. For central government and state government employees, employer contribution, there is an extended deduction. What department say? If you are a central government or a state government employee, then instead of 10%, it shall be 14%. Only the employer contribution. The employer contribution shall become 14%. I hope it is clear. Now, let's solve a problem for a better understanding of this particular flow chart. So, please take question number 2, friends. Please take question number 2 and give me the answer. It's in page number 35 again. Page 35. Take question number 2 and give me the answer. This question will give you a better understanding of 80 CCD. Alright friends, so let's go through the question and solve the answer. The basic salary of Mr. A is 1 lakh per month. He is entitled to DNS allowance, which is 40% of the basic salary. So, basic salary is 1 lakh, DA 40%. So, basic is 1 lakh and DA is 40%, that is 40,000 rupees. Now, 50% of the DA forms part of the retirement benefit. That means out of this 40,000, only 20,000 forms part of the retirement benefit. Yes or no? Listen, 40% of basic salary is the DA. Then 50% of DA only forms part of retirement benefit. That means ultimately only 20,000 forms part of retirement benefit. So basic plus DA will be 1,20,000. Now, both Mr. A and his employer contribute 15% of basic salary to the pension scheme. So annual contribution by the employer and the employee is 15,000 rupees. 15% of basic salary. That's what they say. Not annual, it's per month. Okay, I'm sorry. It is per month. So we'll take it as it is. So 1,20,000 into 12 months. How much is basic salary plus DA into 12 months? 2,44,000. Sorry, 2,44,000? No, 2,44,000. How much is the figure coming? 1,20,000 into 12. It is 14,40,000. Alright, now listen, how much is the actual contribution? That is 1 lakh into 12 into how much? 15%. So, how much will be that? 12 lakh into 15%. How much is the actual contribution? 1,80,000. 1,80,000 is 15% on 1 lakh into 12. So, this is the actual contribution. Then how to take deduction? First, we will consider employee contribution. For employee contribution, up to 50,000, there is no limit. How much is the rest? 1,30,000. For that 1,30,000, you need to check 80 CCD subsection 1. Under 80 CCD subsection 1, how much is the maximum deduction? 14,40,000 into 10%. That is 1,44,000 is the maximum deduction. Yes or no? Since your contribution excess is only 1,30,000, that you can claim it as a deduction. And in total, 1,50,000 plus 1,30,000, 1,80,000 you can claim it as a deduction as employee contribution. Now to the employer contribution. Employer contribution, basic salary plus DA is 10%. That is 1,44,000 is only allowed as deduction. So this is how it is. For employee contribution 1 lakh 80, full you will get it as deduction. Employer contribution 1 lakh 44,000 only will get as a deduction. Is that clear? There is one more thing that you have to consider under this 80 CCD, that is for self-employed persons also. They can take this, they can start with this national pension scheme. So let's understand for self-employed persons. Self-employed persons, how to take this 80 CCD deduction? You have to split this into two. That is under section 80 CCD subsection 1B up to 50,000 rupees you can claim the deduction, and under section 80 CCD subsection 1 they say 20% of gross total income. These are the limits, and this is also subjected to 80 CCE. What is 80 CCE? 80C plus 80 triple C plus 80 CCD subsection 1 shall be less than or equal to 1,50,000, which is mentioned under 80 CCE. So listen, self-employed persons. Listen, what do you mean by self-employed person? A person who is doing job by its own. He doesn't have an employer. So there is no employer contribution in that scenario. So what you need to do is self-employed persons contribution have to be splitted into two. He can maintain national pension scheme. He himself can deposit into that particular scheme and take the deduction. If he himself deposits into that particular scheme, up to 50,000 he can claim it as a deduction without any limit at all. The contribution which is over and above 50,000 have to be deducted under 80 CCD subsection 1, just like the employee case also. 20% of the gross total income will be your maximum deduction under 80 CCD subsection 1, and that is subjected to an overall ceiling under 80 CCE. And how much is that overall ceiling? 80C plus triple C plus CCD subsection 1 shall be lesser or equal to 1,50,000 under 80 CCE. That's what the department says for self-employed person. Don't ask me, sir, why there is no employer contribution? Because he is a self-employed person. There won't be any employer contribution for the self-employed person. I hope that is also clear. All right, friends. So let's complete chapter 6A deductions. The next section which we have to discuss is 80D. Normally we call it as premium paid for health insurance. That is what is 80D is all about. But the problem with 80D is you have a lot of things in 80D that makes it very confusing. Lot of conditions are there. Sub-conditions, conditions, overall limit, subjected to these, that. Lot of things are there. So that makes it very tough for a student to answer a question in 80D. So when I was a student earlier, during my finals, I find it very difficult to by heart all the conditions under 80D. Because department says subjected to these conditions, maximum deduction under 80D is allowable. That's what they say. They are not saying how much you can take. They are saying subjected to all these conditions, how much you can take, that much you take. That's what they say. So when in different circumstances, the limit also changes. So it is very, very confusing. So what I did is, I've created a table. I call it as a magic table. There is no magic, first of all, but only for the sake of calling it, I've named it as what? Magic table. In this magic table, there is a speciality. Whatever figures are there in the question, if you put in this table, you will always get the right answers. Trust me, the answer will never go wrong, because all the conditions in income tax is arranged in a way that this is comparatively easy rather than studying the theory. So I'll teach you the table format. If you are good in 80D, if you think that you already understood 80D, already studied 80D from somewhere else, if you're good in 80D, then don't follow this. What I'll teach you is this, because this, in my opinion, is the best way. How, in whatever permutation combination exam questions comes in, you know the table, you will get the right answer always, trust me. So let's start with the table. So what is 80D, friends? Deduction in respect of medical insurance premium. So let's understand what all are the things that we have. We have to, first of all, we have to categorize 80D into 4 categories. We need to split 80D into how much? 4 categories. Which all are the categories? Category number 1 for family. Category number 2 for parents. Category number 3 for medical expenses for family. Category number 4, medical expenses for parents. There are 4 categories. Listen. Number 1, for family. Number 2, for parents. Number 3, medical expenses for family. Number 4, medical expenses for parents. Are you all with me? Let's understand each and every category in detail. Family, first of all, means individual, spouse, and dependent child. Or we can say dependent children. There is no limit for the number of children that you can have. So, for the purpose of ATD, family means, who all are family? Myself, my wife, and my dependent children. What is this dependent children? Children, they are not earning. They totally depend on my earnings to live. Are you all with me? Now, so individual, spouse, and dependent child or dependent children comes in the family definition. Now, which all are the things that you will get at as a reduction under category 1? Number 1, health insurance premium paid other than cash. Other than cash. What do you mean by health insurance premium paid other than cash? See, if you have taken a family insurance means an insurance that covers me, my wife, and my children, or myself. However, it is no problem. So, if I have taken a family insurance, I can claim it as the premium which I am paying is claimed as a deduction under ATD category 1, but subjected to one condition: the premium should be paid in any method other than cash. I am not supposed to pay the premium in cash. Hope you got my point. Number 2, payment for preventive health checkup. What is preventive health checkup? To check whether I have any diseases or not, I have done a checkup. All the payment that I've done for that checkup is allowable as a deduction under category 1, either for me or for my family. Either for me or for my family, I have to claim it as a deduction under category 1. Are you all listening? All checkups are preventive. Maybe in examination they will say simple checkup. Always preventive. Checkups are always what? Preventive. And one more thing, this preventive checkup payment can be made in any mode. You paid it in cash, no problem. You paid it in check, no problem. So, irrespective of the mode of payment, you will get it as a deduction. And item number 3, that is contribution to central government or state government health scheme, again other than cash. Say you have contributed to central government or state government health schemes and the payment is other than cash, you will get it as a deduction. There are health schemes introduced by the CG and SG. You are making a payment to that, but the payment have to be in any mode other than cash. You will get it as a deduction. So, these are the 3 items covered under category 1. So, friends, repeat with me what all are the items. Number 1, health insurance premium. Number 2, preventive health checkup. Number 3, contribution to state government or central government health schemes. 1 and 3 have to be in any mode other than cash. Preventive health checkup, you can pay it in cash. Absolutely no problem. Now, total. You take these 3 and take the total. The total shall never go beyond 25,000. You take 1, 2 and 3. You take the total. The total should be less than or equal to how much? 25,000. It shall not go beyond 25,000. If it goes beyond 25,000, the maximum deduction that you get is only 25k, not more than that. Hope you got my point. Moving on. Say that individual is a senior citizen as well as a resident. That individual being a senior citizen as well as a resident will get a deduction up to 50,000. Say you are a senior citizen as well as a resident, you will get a deduction up to how much? 50,000 rupees. I hope that is also clear. So that individual, say I am taking a family insurance, then I have to be a resident as well as a senior citizen. What if I am a non-resident senior citizen? Maximum deduction 25k. I am a resident senior citizen, maximum deduction up to 50. It is not blind 50. Your ceiling limit will be from 25 to 50. Because for senior citizens and all, family insurance will be, the premium will be comparatively higher. So they say you can claim up to 50,000 as a deduction. Are you all with me? That is the end of category number 1. I hope you got my point. Alright friends, so let's see the category number 2 right now. So category number 2, they say for parents. And the first thing that you should know, according to the current prevailing law in India, you cannot include your parents as a part of your family. In family insurance, they will never give you a protection for parents. If you want insurance for parents, you have to take a separate insurance. Are you with me? So, family means, according to the law in India, individual, spouse and children. That's it. That's why they are maintaining parent as a separate category. Now, if you are taking an insurance for your parent, You have taken an insurance for your parent and you are paying premium. Then the premium have to be paid in any mode other than cash. You have taken a health insurance and the premium paid should be in any mode other than cash. Then payment of preventive health checkup for your parent. You can pay it in cash, no problem. So preventive checkup, health checkup in both category 1 and 2 can be paid in cash. There is absolutely no problem. Now, for parent, two things are covered. Which all are the things? Number one, health insurance premium paid for your parents. Parents means for your father as well as for your mother. Then, preventive health checkup for your father or for your mother. Both are covered in category 1. Sorry, category 2. You take the total shall not go beyond how much? 25,000. The total which you have paid for your parents shall not be more than 25,000. But there is another thing. Say your parent is a resident as well as a senior citizen. Say your parent is a resident as well as a senior citizen. Then how much will be the deduction? You will get it up to 50,000 rupees. Say your parent is a senior citizen as well as a resident, then you will get a deduction up to 50,000 rupees for category number 2. Are you all listening? That is the end of category number 2. Now let's see what is given in category number 3. So category number 3 says medical expenses for family. Category number 3 says what? Medical expenses for family. What is family? Individual, spouse, children who are dependent. Now, if you have incurred a medical expenses for your family, then there are certain conditions to claim that medical expenditure as a deduction. Are you all listening? If you have incurred an actual medical expenditure from your family, then there are certain conditions to claim that actual medical expenditure as a deduction under 80D. What are the conditions? Number 1, there shouldn't be any health insurance. Why? If you have health insurance, insurance company, the premium already we have given you as a deduction. The insurance company may cover everything, may not cover everything. That is your problem. But we are saying if you have a health insurance, you will not get the actual medical expenditure expended as a deduction. Whether your insurance company cover that expenditure or not. Are you with me? Number 2, 60 years of age. The person who has suffered medical expenditure should be at the age of 60 years. That means your spouse or children should be aged at the age of 60 or plus. Then that person who has suffered medical expenditure should be a resident. So 3 conditions that you have to satisfy. Condition number 1, there shouldn't be any health insurance. Condition number 2, the age should be 60 or more. Condition number 3, that person should be a resident in India. If all the conditions are satisfied, maximum deduction up to 50,000 rupees. That too, the payment should be in any mode other than cash. You should make the payment for the medical expenditure in any mode other than cash. You are not supposed to make cash payments. If you have made cash payments, don't think about deduction. If you have made payment through your card, credit card, Google Pay or whatever mode, you will get it as a deduction under 80D. I hope it is clear. Moving on. Next is medical expenses for parents. So medical expenses for parents means you have suffered or you have incurred a medical expenditure for your parent. Will you get it as a deduction? Subject to the conditions. Condition number 1, the parent should not have any medical insurance or health insurance. The parent's age should be 60 years or more. And finally, the parent should be a resident in India. If all the conditions are satisfied, then maximum deduction up to 50,000. But there is another condition, the payment have to be in any mode other than cash. Are you all with me? So, friends, repeat with me. What was category number 1? Everybody should repeat with me. What was category number 1? For family. What is who all are family? Individual, spouse, children. Now, if individual, for spouse and for children have paid medical insurance other than cash, category 1 deduction. I have given central government or state government health contribution other than cash, then category 1 deduction. I've paid preventive health checkup, any mode, I'll get it as a deduction. Maximum deduction 25. If that individual is a senior citizen plus resident, up to 50,000, you will get it as a deduction. Category number 2 for parents, medical insurance and preventive health checkup. Medical insurance other than cash. Preventive health checkup, any mode. Maximum deduction 25,000. If parent is a senior citizen plus resident, maximum 50,000. Category 3, medical expenditure for family. There shouldn't be any health insurance. The person who has suffered medical expenditure should be a resident plus his age is 60 or more. Then maximum 50,000 provided the payment have to be done in any mode other than cash. Category number 4, medical expenditure for parents. 3 conditions, same 3 conditions. Parent should be a resident, parent should not have medical insurance, and parent, his age should be 60 years or more. All the conditions are satisfied, maximum deduction up to 50,000 provided. Payment have to be, medical expenditure have to be paid in any mode other than cash. 4 categories are done. Conditions are not yet over. Then department say, category 1 plus category 3 shall not exceed 50,000 rupees. What is category number 1? Medical medical insurance premium for family, category 1. Category 3, medical expenditure for family, both together shall not go beyond 50,000. You can take both, but both together shall not go beyond 50,000. Let me ask you one doubt. Medical expenses, if you want to claim it as a deduction, there shouldn't be any insurance. Now the question is, can you claim 1 and 3 together? Can you claim both 1 and 3 together? Because for claiming 3, there shouldn't be any medical expenditure. Sorry, there shouldn't be any medical insurance. Yes or no? Category 1 is for the medical insurance. Then category 1 and 3, will it come together? The answer is yes. I have medical insurance. My wife does not have medical insurance. She is a senior citizen. For her, medical expenditure incurred. For me, the premium paid, I will get category 1 deduction. For wife's medical expenditure, if I have suffered, I will get category 3 deduction. So 1 and 3 may come together. If it comes together, maximum deduction 50,000. Are you with me? If it comes together, 1 plus 3 shall not go beyond 50,000. Likewise, 2 plus 4 shall not go beyond 50,000. 2 plus 4 shall not go beyond how much? 50,000. What is 2 plus 4? 2 for parents. 4 medical expenses for parents. That also may come together. Father has insurance, mother has no insurance. That also may come together. If it comes together, 2 plus 4 shall not go beyond 50,000. Now, preventive health checkup in category 1 and category 2 shall never go beyond 5,000. Preventive health checkup in category 1 and category 2 shall be always less than or equal to 5,000. In both, you have to claim maximum 5,000. By making use of this, how much you can claim, that much you take it as a deduction. By satisfying all the conditions, how much you can claim, that much you take it as a deduction. That's what the department says. Are you all with me? Yes or no? Now let's solve a problem to get a better understanding over this particular provision. So please take your question sheet. So friends, please take page number 35. Page number 35 of our question sheet and solve question number 3. It's a fantastic question. Take page number 35, question number 3. So listen friends, let's solve it together. Mr. A aged 40 years and paid medical insurance premium of how much? 20,000. So Mr. A paid medical insurance premium, that means for category 1. Category 1, medical premium. And how much is the amount friends? How much is the medical insurance premium that he suffered from his pocket? That is rupees 20,000. Yes or no? So 20,000 he have paid. Now, during the previous year 22-23, to ensure his health as well as the health of his spouse. So category 1. He also paid medical insurance premium of 47,000 during the year to ensure the health of his father. So that is category 2. Premium for father. How much is the amount? 47,000. Then during the year to ensure the health of his father, aged 63 years. So father's age is 63, who is not dependent on him. Dependency of factor is not a relevant point. So they are not talking about the residency status of father. So the assumption is he is an Indian resident. Unless otherwise, the question says the person is an NR, the persons will be residents of India, because we are talking about Indian Income Tax Act 1961. All the persons in this question will be always residents in India. Now listen, let's move on with the next point. What they are saying is, he has incurred who is not dependent on him. He contributed 3,600 to central government health scheme. So central government health scheme, 3,600, and the contribution, they are not talking about whether it is in cash or not. So the assumption is, he knows all the law and he have provided it in other than cash. Then he has incurred 3,000 in cash on preventive health checkup. So preventive health checkup, he incurred 3,000 rupees. Absolutely no problem. He can pay it in cash. And 4,000 by check on preventive health checkup for his father. So preventive health checkup for father was 4,000 rupees. Now they are asking you to compute the allowable deduction under 80D. So category 3 and 4 is vacant. Yes or no? There is nothing in category 3 and category 4. So what we can do is, we need to compute the total in category 1. Total in category 1 is 26,600. But you are only supposed to take how much? 25,000. Yes or no? So 1,000, how much it will go? 1,600, you will never get it as a deduction. You need to disallow 1,600. So the remaining 25,000 is the maximum deduction from category 1. Now, how about category 2? The actual figure is 51,000, but you will never get 1,000 rupees as a deduction because maximum deduction shall be 50,000. Are you all with me? Category 3 nil, category 4 nil. So let's check the overall conditions. Category 1 plus category 3 should be less than or equal to 50,000. That is okay. Category 1 you have 25, category 3 you have nothing. So it satisfies the first condition. How about the second condition? Category 2 plus category 4 should be less than or equal to 50,000. Category 2 is 50, category 4 is nothing. Hence that condition is also satisfied. Now in relation to the preventive health checkup condition. So preventive health checkup in category 1 plus category 2 should be less than or equal to 5,000. Now the preventive health checkup in category 1 is 3,000 and category 2 is 4,000. But one point you have to consider, in category 1 there is a disallowance of 1,600. In category 1 there is a disallowance of 1,600. That disallowance you can take it from anything. From preventive health checkup, from insurance premium, from capital gains, central government health scheme, or from preventive health checkup. For the better way, you need to consider it from the preventive health checkup so that the preventive health checkup will come down. Automatically, the overall condition will get satisfied. So, I am disallowing this 1,600 from preventive health checkup. So, how much will be the preventive health checkup? Only 1,400. So, this 20, this 3,500 and this 1,400 become 25,000. You got my point? You are not supposed to deduct it from 25,000 because already in category 1 there is a disallowance of 1,600. You take that disallowance from preventive health checkup. So that overall total will be 25,000 and preventive health checkup will go down. Are you with me? From category 2 also you have a disallowance of 1,000. You claim it from preventive health checkup. So effectively preventive health checkup is 3,000. 3,000 plus 1,400 it will be under 5,000. So automatically that condition also will get satisfied. This is the advantage of this table. If you have, so the moral of the story is, while solving in this table method, if you have preventive health checkup in category 1 and 2, always disallow the excess from the preventive health checkup. Automatically the preventive health checkup condition will get tallied. Are you with me? And hence we can say you can take that entire 25 as well as 50 as a deduction. So 75,000 rupees is the total deduction under 80D. I hope it is clear. Yes or no? So I hope you got 80D. Now there are a few points in relation to 80D. Thereafter we will move on to the next point. Listen, say this preventive health checkup can be paid by an HUF. Not preventive health checkup, sorry, medical insurance. Medical insurance can be paid by an HUF. Are you with me? If an HUF has taken a medical insurance for the family as it is, then they can claim that premium paid as a deduction. Now, if they have taken a medical insurance for any of their family members who are senior citizen, then they can claim up to 50,000. Otherwise, 25,000. Are you with me? If you are an individual, then this table is applicable. If you are an individual, then this table is applicable. If you are an HUF, then 80D deduction shall be only for what? Only for the health insurance premium that you have paid for your family. Normally it is 25,000. If your members are senior citizen, then you will get a deduction up to 50,000. Now, any member is senior citizen, you will get 50,000. It doesn't say that all of the members have to be senior citizens. Any one member. Normally the Karta and all will be the senior guy. If he is 60 plus, superb. Plus he have to be a resident, okay. He have to be a resident and senior citizen, then you will get a deduction up to 50,000. Now, listen, there also payment have to be made in other than cash. Now there is a problem here. Listen, you can pay premium for multiple years. There is an option given by most of the insurers that you can pay premium for multiple years. If you are paying premium for multiple years, then what to do? Let's understand. You can pay premium for multiple years and what to do with those kinds of premium. Let's understand. Are you all listening? Now listen, I'll give you a simple example. Please be very attentive. You can study this from here itself. Please be very attentive. Say for example, on 1st June 2022, I've taken a 3-year policy. 3-year policy and I paid a premium of 4 lakh rupees. And I paid a premium of 4 lakh rupees. Are you all with me? Now listen, this premium is said instead of 4 lakh rupees, I'll take 40,000. Okay, 4 lakh is way too high. I'll take 40,000. 40,000 rupees are paid for how many years? 3-year policy it is. Now you tell me, when will that policy get expired? What will be the date of expiry of that particular policy? Tell me the exact date of expiry of that particular policy. 2022 you started. You will get 3 years. So 23, 24, 25. So 2025, 31st May 2025, the policy will get expired. Because on 1st June, you will not get the coverage. 1 year starts from January to 31st December. Likewise, if you pay premium in between, you will get the protection till the very last day. So it is from 1st June to 31st May. How many previous years are involved in this period? Don't say 3. How many previous years are involved? PY 22-23 is there. PY 23-24 is there. PY 24-25 is there. And PY 25-26 is there. Because it ends with 31st May 2025. That May comes in 25-26 bracket. Yes. How many years are there? 4 years are there. So this premium have to be divided by 4, not by 3. In exam, if they ask a question like this, for 3-year policy and all, if they say a start date, don't jump into a conclusion that you have to divide it by 3. It is not like that. The Act says how many PYs are involved. On basis on that, you need to apportion it. In this point, there are 4 PYs involved. Starting from 1st June. 1st June is in 22-23 PY. Then 23-24 is fully there. 24-25 is fully there. 25-26 only April and May is there. That is enough. You take 40,000 divided by 4. So per year premium should be 10,000. Are you with me? This is how you have to deal with multiple year premium payments. It has been tested for inter. You can see related questions in the practice manual. Are you with me? All right. So let's move on. By that I can say 80D is completely over. I hope all of you got the point and all of you are with me. Alright friends, so let's move on with the next item, that is deduction in respect of medical treatment, etc., which is under section 80DDB. It's a very simple item. Listen, say for example, you are a assessee who is a resident in India, being an individual or HUF. Say you are either individual or HUF, you are a resident in India and you have suffered some expenditure for medical expenses. You have expended something for medical treatment. Then what department says, the deduction is available to an individual for a medical expenditure incurred on either for yourself or for a dependent. It is also available to Hindu undivided family for such expenditure incurred on its members. Then what they are saying is, any amount actually paid for the medical treatment of such disease or ailment as may be specified in the rules made on this behalf by the board for himself or dependent in case assessee is an individual, or for any member of HUF in case assessee is an HUF, will qualify for deduction. Very simple friends, listen. Either you are an individual or you are an HUF. You have incurred for either self or dependent. The HUF either have incurred for members. What medical expenses? Medical expenses for prescribed diseases. Prescribed diseases. Prescribed diseases. What all are the prescribed diseases? That we don't have to study. Because in the income tax, Central Board of Direct Tax has prescribed certain diseases like cancer, tumor, etc. So those diseases, if you have incurred any medical expenditure, being an individual or HUF and resident in India, you should be an Indian resident, then you can claim a deduction under which section? 80DDB. Are you all here? How much is the deduction? Department say maximum deduction shall be 40,000 rupees. That simply means actual expenditure or 40,000 rupees, whichever is lower. Say you are a senior citizen as well as a resident, then your deduction shall be actual expenditure or 1 lakh, whichever is lower. Are you all with me? Say friends, listen, either you are an individual, incurred an expenditure for yourself or for your dependents, or you are an HUF, incurred an expenditure for members. Expenditure means for prescribed medical expenditures. If you have incurred that, you will get a deduction. How much is the deduction? Either actual expenditure or 40,000, whichever is lower. If you are senior citizen as well as a resident, you will get up to 1 lakh rupees or actual expenditure, whichever is lower. Are you all with me? Now, the medical expenditure, it have to be certified by a practicing doctor. Don't say practicing chartered accountant, okay? Practicing doctor, that you have to certify that you have this prescribed disease. Are you all with me? Certificate, suddenly don't say, sir, practicing chartered accountant have to certify that you have this particular expenditure. Sorry, you have this particular medical problem. How can a chartered accountant certify? You can certify anything. You can blindly certify anything. But he's not an expert to certify, right? So income tax department say, not the chartered accountant, it should be the practicing doctor. That means the expert. Now listen, who is dependent? Here dependent means spouse, children, parents, brothers, sisters of individual, or any of them wholly and mainly depends upon individual for his support and maintenance. All of them have to be dependents. Either individual, he is dependent on himself, yes or no? Or spouse, children, parents, brothers, sisters, etc., who depends upon that individual for their daily living. So these are the categories mentioned under 80DDB. Are you all with me? Are you all with me? It is very simple provision. So medical expenditure for prescribed diseases for individual or for HUF. Now let's move on. I forgot to explain one section in between. That is 80DD. Where is DD? It is somewhere in between. So friends, there is another section which is actually missed from this ebook. So I will write it here. That is 80DD. I will write the DD here. So next is section 80DD, which is accidentally missed from the ebook. All right, listen. 80DD means deduction in respect of medical treatment or maintenance of dependent disabled. So let's understand what is this medical expenditure or maintenance of dependent disabled. So listen friends, first of all, you have to be a resident individual. You have to be a resident individual or HUF in India. If you are a resident individual and HUF in India and you have a dependent disabled, DD, I will call it as what? DD. What is DD? Dependent disabled. Who is dependent? Who is dependent? Let's understand who all are the dependents. Number one, spouse. It should be dependent. Or children. There also should be dependent. Or parents. Or brothers. Or sisters. Alright. So if these guys are depending on you and any of them are disabled and they are disabled too, then for their training or for their rehabilitation or for their medical expenditure or for their medical needs, you need to expend something. You need to incur expenditures. Say for example a blind or some guys with autism and all. You require them to, for maintaining them, you require therapies, you require treatments, you require rehabilitations, etc. If you are expending anything for that, then you will get a deduction. It is for the dependent disabled. It is actually easy. DD means dependent disabled. You have a dependent who is disabled and for his training, rehabilitation, medical needs, etc. you have expended something, then you will get a deduction and the deduction shall be rupees 75,000. Deduction shall be rupees 75,000 irrespective of actual expenditure. What is irrespective of actual expenditure? It is just like a standard deduction. You have incurred any expenditure, you will get 75,000. You have incurred only 100 rupees, you will get 75,000. Are you all with me? It is just like a standard deduction. You have incurred more than that, you will get only 75,000. Now, one more thing. They are also saying one more thing. If the disability is 80% or more disability, if the disability is 80% or more, that means it have to be certified by a medical practitioner stating that that person's disability is 80% or more. In that case, department say your expenditure shall be 1,25,000 rupees. Your deduction shall be, not expenditure, deduction shall be 1,25,000 rupees instead of 75. If the disability of that particular person is 80% or more, then you will get a deduction up to 1,25,000 rupees. Are you all with me? This is for dependent disabled. If you yourself have the disability, then it is covered under 80U. If you yourself, that is 80U yourself, 80DD, dependent disabled, whether it is intentional or unintentional, we can relate it like that. 80U, you are the person with the disability. 80DD, dependent disabled. And for you, same condition with only one difference, that is you are expending something for yourself. You will get 75,000. Your disability is 80% or more, you will get 1,25,000. Are you with me? But there is one more point. Say you and your dependent is disabled. You are disabled, your dependent is also disabled. In that case, you can take either 80U or 80DD. You cannot take both. Say you are disabled and your dependent is also disabled. You are expending for yourself and for the disabled. You can take either 80DD or 80U on your wish. You cannot take both. Are you with me? That's what the department says. So two sections are over. You as well as DD, dependent disabled. I hope this much is clear. Now, moving on to the next section, friends, that is 80E. 80E, that is loan taken for higher education, interest on loan taken for higher education. That's what we are about to discuss, 80E. So friends, let's start with 80E. What 80E is saying, listen, say you have taken a loan for your higher education. What do you mean by loan for your higher education? Loan for your higher education. You have taken a loan for your further education. Are you all with me? Now, when you have taken a loan, you have to pay what? Interest. That interest you can claim it as a deduction under 80E. So you have taken a loan for your higher education and you are suffering an interest. That interest is allowable as a deduction under 80E. That's what we are about to discuss. Now listen. What the department say is you should be an individual to claim this. Company's higher education will never take a loan. Yes or no? Will company take a loan for company's higher education? No. So the individual only will take a loan for education. Loan will be given only to individuals. So if you have taken that and you have paid interest, then an interest is allowed as a reduction under 80E. There are certain conditions. Number one, the loan should be from any financial institution or an approved charitable trust. The loan should be taken from an financial institution or an approved charitable trust. Say you have taken a loan from your friend and you are paying interest. Will you get that interest as a reduction under 80E? No. It have to be taken from a financial institution or from an approved charitable trust who provides these kinds of loans. Now, next is you can take this loan either for yourself or for your relative. You can take this loan either for yourself or for your relatives. Who are the relatives? Spouse and children. That's it. For spouse and children also you can take this loan. Say for example, a parent taking an education loan for the studies of his child or children. Definitely the parent can claim an 80E deduction. Now, listen, and then the next point is, or you can take a loan for a person. That means, say for example, for a student that you are being the legal guardian. What do you mean by legal guardian? Say for example, my sister's son, he has nobody, I am his legal guardian. Then I can take an education loan for him also. Then I can claim that interest paid as a deduction. If you are taking that loan for a student, you are being his legal guardian, then you can claim the interest paid for that person, that student also as a deduction under 80E. Are you listening? Now, listen. Now, the next point is, there is no ceiling limit for the interest. There is no ceiling limit for the interest, but the department say one thing. You can claim deduction starting from the first year plus maximum 7 more subsequent years. That means maximum deduction shall be for 8 years. Including initial year. What do you mean by including initial year? Say your loan repayment tenure is more than 8 years. only up to 8 years interest you can claim deduction. Your loan repayment tenure is less than 8 years. Say it is 5 years. Then for the 5 years you can claim deduction. If it is more than 8, not possible. So the department say, in respect of initial assessment year and 7 succeeding assessment year. They say initial assessment year and 7 succeeding assessment year. That means maximum 8 years including initial assessment year. Are you with me? The language that they use is initial assessment year plus 7. Instead of that, we can say 8 including initial. Are you with me? There is no ceiling limit and all, but there is a time frame limit. Maximum 8 years is the deduction allowable. I hope you guys are with me and it is clear. So friends, next deduction is actually 80EE, but I will tell you, you don't have to study 80EE because the loan have to be taken between 2016-17. Now for you, it is the relevant PY for you is 22-23. So if you have taken a loan in 22-23, this 80EE is not applicable for you. You have another section called 80EEA. For the time being, you don't have to study 80EE, but there is a possibility that 80EE can come. You have taken a loan in 16-17, that repayment is still there. That is the rarest possibility. So it is there as a part of the syllabus, but not an important section. So we don't have to waste our time on 80EE. Next is 80EEA. 80EEA I'll teach you. Listen, 80EEA, what department says is, deduction in respect of interest payable on loan taken for acquisition of residential house property. Listen. Say you have taken a loan for purchasing a residential house property. There are certain deductions. Number one, the interest is allowable as a deduction under house property. 24B, principal repayment allowed as a deduction under 80C, subject to the ceiling limit under 80C. Again, you will get another deduction for the interest payment, that is under 80EEA if you satisfy the conditions under 80EEA. Are you all listening? You have taken a loan for purchasing or constructing a residential house property. You will get 24B deduction under house property. You will get 80C deduction under chapter 6A. Again, you will get another deduction under 80EEA subject to certain conditions. That's what we are about to discuss. Listen, the first point is, you should be an individual who has taken a loan for acquisition of residential house property from a financial institution. You should be an individual who have taken a loan for acquisition of what? Residential house property from financial institution. That is the first thing. Then, interest payable shall be allowed as a deduction subject to certain conditions. Only for individuals you will get this deduction and they have to satisfy certain conditions. Are you all listening? You are an individual, taken a loan for the purchase or construction of your residential house property. You are eligible for 80EEA subject to certain conditions. Let's understand the conditions. Number one, stamp duty value of that particular property should be less than or equal to 45 lakhs. Stamp duty value of that particular property should be less than or equal to how much, friends? 45 lakhs. If you bought a huge property, you will not get the deduction of 80EEA. Only for small properties that having a value of 45 lakhs or less, SDV, 45 lakhs or less, you are eligible for deduction. Number two, the loan should be sanctioned by financial institution during the period between 1st April 19 and 31st March 2022. There is a problem for that also. In 22-23 you have taken a loan. Will you get the deduction? No. The loan should be sanctioned between 2019 and 2022 31st March. That means right now it is not active. Right now it is not active. The sanction period should be between 19 and 22. Then the individual should not be eligible to claim deduction under 80EE. That means you are not supposed to take the deduction, that the section which we have skipped. We don't have to consider that condition here. Then next is, individual should not own a residential house on the date of sanction of loan. That simply means you should be the first home buyer. Individual should not own any residential house on date of sanction of loan. See, what's they mean? They mean with the loan you should purchase your first house property. That simply means you should be the first home buyer. First home buyer means this is the first home in your name. Then you can claim this deduction. Are you all listening? Let's understand how to claim the deduction. Now, departments say you can claim deduction until otherwise your loan is fully paid. There is no time frame limit and all. You can claim deduction until otherwise your loan is completely repaid. But there is a problem. Maximum deduction shall be 1,50,000. Maximum deduction under 80EEA. shall be how much, friends? 1,50,000 rupees. That's what the act says. So what do you mean by this? Let's understand the meaning of this particular point. So listen, say for example, I'll give you an example. Say I've taken a loan for my house property. After taken a loan for my house property, say the principal repayment in a year is say 3 lakh. I'm paying 3 lakh rupees as principal repayment. Then the interest repayment in a year is say 5 lakh. Interest repayment in a year is how much? 5 lakh. Now let's understand. Out of this 3 lakh principal repayment, 1,50,000 I can claim as a deduction under 80C. Yes or no? Out of the 3 lakh principal repayment, 1,50,000 I can claim as a deduction under 80C. I will not get any further deduction. I will not get any further deduction for the principal repayment. For the interest repayment, I have to split this into two. Interest repayment have to be split into two. The first deduction should be under 24B. How much is the reduction under 24B? Up to 2 lakh. Because being a self-occupied house property, that residential house property this is my first home. So if it is a residential house property, I can claim up to 2 lakh rupees. Are you all with me? Now, then over and above, my actual interest is 5 lakh. So if I have an interest only over and above 2 lakh, I can claim it as a deduction under 80EEA. It is not double deduction. Actual interest over and above 2 lakh is only subjected to 80EEA. Otherwise, it will be double deduction for a single interest payment. Are you with me? There is an interconnection between 80C and 24B and 80EEA. You should know that. Are you all here? Now, my actual interest is 5 lakh. 2 lakh I've already claimed under 24B. How much is the remaining? 3 lakh. Can I claim that entire 3 lakh under EEA? No. Maximum deduction under EEA is how much? 1,50,000. That's it. This is how you must claim deduction under 80EEA. It is not for the actual interest. It is over and above, the actual interest is over and above 2 lakh only, you can claim it under 80EEA. Otherwise, not. Are you all listening? Hope you got my point. Alright friends, so let's move on and discuss the other things. So the maximum deduction is 1,50,000. I hope it is clear for you. Now listen, that was 80EEA. So we have completed 80EEA, we have 80EEB, that is more interesting. That is, you have taken a loan for purchasing electric vehicle. You will get interest on that particular loan as a deduction under 80EEB, that is for the purchase of electric vehicle. So let's understand friends. For claiming this, you have to be an individual. An individual purchasing an electric vehicle by taking a loan from a financial institution is eligible to claim interest paid on that loan as a deduction from 80EEB. Listen friends, you have to be an individual. That is the first thing. You have to take a loan for the purchase of electric vehicle. That is second thing. Third thing, you should take that loan from a financial institution. All these things have to be satisfied. Now, then the interest payable is allowed as a deduction. Now listen, there are certain conditions that have to be satisfied. So let's understand the condition. Number one, the loan should be taken for the purchase of electric vehicle. We have already said that. Point number two, the loan should be sanctioned between 1st April 2019 and 31st March 2023. It should be sanctioned between 1st April 2019 and 31st March 2023. Then the loan should be taken from a financial institution. The loan should be taken from a financial institution and the assessee should be an individual. If all the conditions are satisfied, then you will get interest on loan as a deduction from your taxable income. Now listen, how much you will get it as a deduction? I say maximum 1,50,000 is the figure that you can claim as a deduction. Not more than 1,50,000. Friends, listen, I'm not talking about the principal repayment. I'm only talking about the interest portion. You have taken a loan for the purchase of an electric vehicle, an EV, and you have taken a loan for that. And the interest that you are suffering is allowed as a reduction up to 1,50,000 subjected to satisfaction of this condition under section 80EEB. I hope you guys are with me. That's it. Moving on with 80GG. It's a super item, 80GG. Listen. Say you are a person who is not in receipt of HRI. What is HRI? house rent allowance. You are a person who is not in receipt of HRA, that is house rent allowance. You are not receiving any HRA. Alright, say you are not in receipt of what? House rent allowance. Listen, you are paying rent from your pocket. You are paying what? Rent from your pocket. You are eligible to claim 80 GG deduction. If you are a person who is a receipt of HRA, you are not eligible to claim what? 80 GG deduction. If you are a person who is not in receipt of HRA, you are eligible to claim 80 GG deduction. There are certain conditions that have to be satisfied. So let's understand all the conditions in a detailed manner. Are you all listening? Listen. Number one, you have to be an individual. Whether you are resident or citizen doesn't matter. If you are an individual, you can claim 80 GG. There are certain other conditions. Now, first one, you shouldn't receive any house rent allowance. Then you should not have a house in your place of employment. If you have a house in your place of employment and you are staying in rent, we will not give you 80 GG. You don't have a house in the place of your employment. That doesn't mean you don't have any house. You don't have a house in the place of employment. Say I have a house in Kochi and I'm staying in Chennai as a part of my employment. I don't have a house in Chennai. Am I eligible for 80 GG? Yes, provided I didn't receive HRA. Now, so, and again one more thing. I should stay in a house whether there is an actual rent liability. Say in Chennai, I am staying in my sister's house. Can I claim 80 GG? No. In Chennai, I shouldn't have a house. Plus, I should stay in a house where there is a rent liability. So, he or a spouse or minor child or HUF and he is a member should not own a residential house at a place where assessee resides, perform the duties of his house or employment or carries on business or profession. So, listen, say my wife has a house in Chennai and I'm paying her rent. And I'm paying her rent, I'm not receiving any HRA. Can I claim 80 GG? No, because the department say, you, your spouse, your minor child or HUF where you are a member should not have a house in the place of your employment. Are you with me? Say, my parent have a house in Chennai and I'm staying in that property and I'm paying rent to my parent. Can I claim 80 GG? Yes, because they are very specific. Your spouse, minor child, HUF that you are being a member should not have a house property in your place of employment. That means your parents, your brother have a house property and paying rent. Claim deduction under 80 GG. But there should be a proper rent agreement and you should pay the rent. Yes or no? It is not like simply saying, yeah, I'm paying rent to my parent. And that is not possible. You should have a proper rent agreement and you should pay a proper rent. That's it. Now, then the next point is there should be a proof of rent payment and no claim for the benefit of self-occupied property. Assessee should not treat any residential house situated in any other place as self-occupied property. My house at Kochi is a self-occupied property. Yes or no? But I'm not supposed to claim any benefit under house property. That means I'm not supposed to claim any interest as a deduction. Say I don't have any interest. Then that case I am eligible for 80 GG deduction. Say I have a house property at Kochi and I'm taking 24B deduction. Can I claim 80 GG? No. That's what they say. No claim for the benefit of self-occupied house property. Assessee should not treat any residential house situated at other place as a self-occupied property under 23(2)(a) or 23(4)(a). Now, he have to incur a actual rent and proof of payment should be there. What is proof of payment? Either challan or some Google Pay receipt or something should be there. You have to maintain that. Then you can claim deduction. Now, whether it is a furnished property or unfurnished property doesn't matter. The point is you have to suffer the rent. Whether it is furnished or unfurnished, you can claim 80 GG. Now, when you come across this number of conditions, you will think that 80 GG is a big deduction. Nothing. It's only a small deduction. It's a 80 GG deduction shall be minimum of the following. What do you mean by minimum of the following? Least of the following, you will get it as a deduction. Which all are the limits? Either 5,000 per month or 25% of the total income for the year. What do you mean by total income there? Listen. They say first limit as 5,000 per month. Second limit, 25% of the total income. What is total income over there? They say arrived after making all deductions under chapter 6A except 80 GG. What do you mean by that? Listen friends. Normally what is total income? Normally, what is total income? Gross total income minus chapter 6A deduction. But for the purpose of 80GG, 25% of total income, when they say, their total income means gross total income minus chapter 6A deduction except 80GG. Why? You don't know 80GG. That's why they are saying except 80GG. You know 80GG only when you get that second limit S. So they say except 80GG. Then the third one, excess of. Third one, rent paid minus 10% of gross total income. Rent paid minus 10% of gross total income. How much is the rent paid? Minus 10% of gross total income. If you are not paying any rent, you will not get the benefit of 80GG. There is one note also. While calculating adjusted total income, casual income like winnings from lottery, etc. should be included. While calculating adjusted total income, you include everything. Minus chapter 6A, except 80GG. Lower of the following shall be the deduction under 80GG. Is that clear, friends? Yes or no? So what are the limits? Repeat with me. 5,000 per month or 25% of gross total income or actual rent paid minus 10% of gross total income as the deduction under 80GG. I hope it is clear. Friends, now let's solve a small problem in relation to this 80GG. So please take the question sheet. So friends, take question sheet page number 37. Page 37. Take question number 8 and give me the answer. Page number 37. There is a question, question 8. Give me the answer. So let's solve that question together, friends. So I'll read the question. Mr. Ganesh, a businessman whose total income before allowing deduction under 80GG for assessment year 23-24 is 4,60,000. So it is before 80GG, total income is 4,60,000. Paid house rent of 12,000 per month in respect of residential accommodation occupied by him at Mumbai. Compute the deduction allowable to him under section 80GG for assessment year 23-24. So let's compute it together. Not a big deal. So how all are the limits? Number one, 5,000 per month. So 5,000 into 12. They are not talking about any month. So for the whole year they have stayed. That is 60,000 rupees. B. What's the second point? 25% of the total income for the year. 25% of the total income, they clearly says that 4,60,000 is the total income before 80GG. Total income means after 6 deduction. Before 80GG. That means that is the total income. On that 25% you have to apply. Yes or no? So on that figure, 4,60,000 into 25%, how much will be the figure coming? The figure is 1,15,000. Now, what about the third limit, friends? Actual rent paid minus 10% of the gross total income. How about the actual rent paid? 12,000 into 12 minus 10% of the rent, 10% of the gross total income means 4,60,000 into 10%. How much will be the figure coming? 98,000. So let's take that as 98,000. So whichever is lower is the 60,000. So 80GG deduction is how much? 60,000 is your 80GG deduction. That is the final answer to the question. I hope it is clear. So friends, let's move on with the next deduction, that is deduction under 80GGA. It is very easy. Say for example, hope you remember, under PGBP, if you are donating something to a external fund for scientific research, say for example, scientific research institution or an institution which does social science or statistical research, or you are giving to an Indian company who does approved scientific research, or you are giving anything to National Laboratory or IIT for approved programs, etc., you can claim that amount donated as a deduction. Yes or no? You can claim that amount donated as a deduction under section 35 outside contribution. Are you all listening? Say I'm a person who does not have PGBP income. I'm a person who does not have what? PGBP income. And I have given those outside contributions to a research institute or to this scientific research organization or social science statistical research or IIT National Laboratory, etc. Can I get deduction under 35? No, because I don't have PGBP income. Such cases, such persons can claim deduction under 80GGA. Number one, for that approved institution, if I give any donation, I can claim 80GGA deduction. Then number two, say I am giving any donation to National Urban Poverty Eradication Fund. Hope you remember that National Urban Poverty Eradication Fund, 35CCA under PGBP. Say I'm a person does not have PGP income and I'm contributing to National Urban Poverty Eradication Fund. I will get a deduction under 80 GGA. Salaried persons who make all these contributions will get a deduction under 80 GGA. Why? Because I don't have PGBP income, so I cannot section 35 deduction. So department say an alternative. You give all this deduction, all this donation, you take deduction under 80 GGA. Is that clear? Is that clear? It is as simple as that. Now, it is fully deductible without any other conditions. The only condition they are saying is the donation should be paid other than cash. Cash donations, we will not allow any deductions. You pay the donation other than cash. You will get the deduction. 80 GGB we have already covered. What is GGB? A company who is giving political party donation or donation to electoral trust other than cash will get a deduction under 80 GGB. I have referred it under section 37 under PGBP. Hope you remember. So a company which pays political party donation other than cash will get an 80 GGB deduction either to political party or to electoral trust. Hope you remember what is electoral trust. Now, then, if you are an assessee other than company, you will get 80 GGC. And they are also saying one more thing. Under 80 GGC, local authority and artificial jurisdictional person are not supposed to take deductions. That simply means local authority is not supposed to pay any political party donation. If they are allowed to pay political party donation, then what will happen? All the panchayat, municipality, etc. will give donation to the respective ruling political parties. Yes or no? So, local authorities and artificial jurisdictional person, AJPs, are not allowed to give any political party donation. If they give, they will not get any deduction. Apart from that, apart from companies, apart from them, if you are an individual giving a political party donation or an electoral trust donation, you will get the deduction under 80 GGC. So, the theory is simple. Company SC GGP, other SC GGC, other SC excluding local authority and AJP. Are you all with me? 100% deduction without any limit and all. You will get it as a deduction. Moving on to the next one is 80 QQB. So, let's understand what is 80 QQB. Alright, so let's move on, friends. 80 QQB, that simply means it's also very simple. Say you are a resident individual. You are a resident individual as well as a book author. What do you mean by book author? You have written a book, that's it. You have written a book in the field of either literary books, just like Harry Potter or something, literature, or artistic books, something related to the art, tradition, etc., or scientific nature. You have written a book on based on Mars, Moon, etc., aeronautics. Alright. So, literary book, artistic work, or scientific nature book, and you are in receipt of what? Royalty. What is royalty? See, once you have written a book, you need to give the copyright to a publisher. Otherwise, you have to self-publish. If you're giving a copyright to the publisher, you will get royalty. That royalty is allowable as a deduction under 80 QQB, but you have to be whom? An resident individual. Then if you are receipt of royalty, then how much is the deduction? Department say either rupees 3 lakh or actual royalty, whichever is lower. Either actual royalty, whichever is lower, shall be the maximum deduction under 80 QQB. So, friends, listen, you have to be an individual plus a resident in India, and you have to pay what? You have to pay, you are in receipt of royalty income. Then you can claim what? You can claim deduction under 80 QQB. And how much is the deduction? Either actual royalty amount received or rupees 3 lakh, whichever is lower. So, it's a deduction given to those book authors who are in receipt of royalty income. Now, listen. Say your books are sold by a publisher. It has been copied by a publisher and he is selling the books. He is giving you royalty not on lump sum basis. He is giving you royalty based on the book sold. Say, for example, those celebrated authors like J.K. Rowling and all, who is the author of Harry Potter, they will get percentage of the book sold as a royalty rather than lump sum royalty. How many books they are able to sell? A percentage will be given as what? Royalty. In such case, there is one more limit. Either 3 lakh or actual royalty received or 15% of the books sold. 15% of the books sold shall be the limit. Whichever is lower shall be the limit. So, if you are in receipt of royalty, not lump sum, based on the books sold, then there is one more limit. What is the third limit? 15% of the books sold shall be the royalty. Now, one more thing. if your royalty income is less than 3 lakh, then that much only will be your deduction. Don't claim deduction 3 lakh and end up in loss. You got my point. Your actual royalty is only 2 lakh. Then that's what they're saying actual royalty. They're putting a limit. You cannot claim this deduction and end up in loss. Now, there is one more thing. Say, for example, you are an Indian author. Your books are getting published in overseas, in US. Are you all listening? You are an Indian author and your books are getting published in overseas, in a foreign country. Then, department say, for claiming this 80 QQB deduction, you have to bring that royalty received in the foreign country to India. Are you all listening? Say, I am Mr. JK. I am a book author of a particular book and my books are being sold in US and I am receiving royalty in US. I have to bring that royalty amount into India. Then only I will get what? Deduction. Whether I bring or not, that is taxable. If I want to claim deduction, I need to bring that royalty amount into India. When I should bring, department say, such receipt should be brought into India by the assessee in convertible foreign exchange within 6 months from the end of previous year or within such period as may the competent authority may allow on this behalf. So listen, what I need to do is, either I need to bring it in foreign exchange. What do you mean by foreign exchange? That foreign currency I have to bring here. Why department is mandating this? Because to increase our foreign exchange reserves. Say for example, I need to bring it in dollars. I have to bring that dollars into India so that we have more foreign currency. We don't have to buy that currency. Now listen, I need to bring the dollars into India within what time? Maximum 6 months from the end of the PY. Maximum 6 months from the end of the PY. I can bring it any time before. Maximum time is from the end of PY 6 months. If I didn't bring that within 6 months, I will not get deduction. Are you with me? Only a part is brought. Only for that part I can claim deduction. The rest I cannot claim any deduction. Are you with me? Are you with me? There is one more point. And assessee must submit a certificate in form number 10H along with the return of income stating that this income is this much. This has been received on this dates and all. So there should be a form. That form is called as form number 10H. That form also is required to be uploaded. Then only I will get a deduction under 80QQB. Now there is one more point. The competent authority, say for example RBI and all, may extend the 6 months time to further some point. Say they have given me 7 months time. Then I need to bring it within that 7 months. That's why they have written or within such further period as the competent authority may allow in this behalf. Either central government or RBI has given me an extended time to bring that money. Then I have to bring that money within that time. Are you with me? If I didn't get any extension, the maximum time is 6 months. So that is the point. Now the quantum of deduction which we have already discussed, that is either 100% of the royalty income or 3 lakh or 15% of the books sold, provided royalty income received in more other than lump sum. That means based on the books sold. So this is 80 QQB deduction. I hope it is clear. This is important also. Are you all with me? Moving on. Next is 80 RRB, that is deduction for royalty on patent. Royalty on patent. What is royalty on patent? What is patent, friends? Patent. I have an invention registered in my name and then I am called as the patent owner of that particular invention. Just like a discovery or an innovation or a new model of something. Say I am the patent owner of a particular thing. I am the patent owner of an invention. Then I'll get what? Royalty on patent. If I get royalty on patent, I'm eligible to claim deduction under 80 RRB. Are you with me? Say I'm a scientist and I'm getting royalty on my patent. Then I'm eligible to claim deduction under 80 RRB. So let's understand how to claim this particular deduction. Simple it is. I have to be a resident individual. You can compare it with the QQB. Almost same. Only subject to one difference. The other one was book authors. QQB. RRB is for the royalty owners. Patent on royalty. Assessee have to be a resident individual. Then next point is maximum deduction shall be either 100% of such royalty or 3 lakh, whichever is lower. Then again, I have to bring, if I'm receiving royalty from overseas, I have to bring that royalty to India. You tell me the time. 6 months from the end of the relevant previous year or such extended time. Same condition. And I have to file form number 10H along with my return of income stating the particulars of the foreign receipt. Are you all with me? Exactly same. Only one difference. Two difference we can say. Number one, QQB is for royalty for book orders. RRB is for royalty and patent. In QQB, there is one more condition. 15% of the book sold. Royalty, there is no such condition. It will be always lump sum or royalty. I hope this much is clear. Next is 80TTA. Another easy and simple deduction. 80TTA, it means, say you are an individual or a Hindu undivided family and you have savings bank interest. You have what? SB interest. What is SB? Savings bank interest from a banking company or a cooperative bank or post office. You are an individual or HUF and you have what? Savings bank interest income. Savings bank interest income is taxable under IFOS. From that income, you can claim 80TTA deduction provided the savings bank interest income is from a banking company or a cooperative society engaged in banking business. That's what I said, cooperative bank or a post office. Then I can claim up to 10,000 rupees as a deduction. Maximum deduction. What is up to 10,000? Either 10,000 or actual interest income, whichever is lower. So that's what they say. The deduction shall be lower of the following. Either actual interest income or rupees 10,000, whichever is lower. Are you all with me? Hope it is clear. Next is 80TTB deduction. That is also important. Say you are a resident senior citizen. This is very, very important. You are a resident plus a senior citizen. Resident means Indian resident. Senior citizen means having an age of 60 or more. Your income, you are in receipt of interest income on deposits. You are in receipt of interest income on deposits. Deposits means either savings bank interest or fixed deposits. Whatever it is. Either savings bank or fixed deposits from a banking company or a cooperative bank or post office. Then you can claim 80TTB deduction. And the deduction shall be either actual interest or 50,000, whichever is lower. Either actual interest or 50,000, whichever is lower. Listen friends, say I am a senior citizen plus resident and I am in receipt of either savings bank interest or fixed deposit interest. I can claim a deduction up to 50,000. Either actual interest amount or 50,000, whichever is lower. Can I claim both 80TT and TTB? The answer is no. Department say, look at this. If I am a person that is a resident senior citizen who is eligible for deduction under TTB, then I am not supposed to claim TTA. If I am eligible to claim TTB, then I am not supposed to claim TTA. For a resident senior citizen, the deduction is TTA. For a normal person, deduction is for a resident senior citizen, deduction is TTB. For a normal person, deduction is TTA. But TTA is only for savings bank interest income. TTB covers everything. Whether it is savings bank or whether it is FD, covered under TTB. And the deduction shall be maximum 50,000. Are you all with me? Are you all with me? So the point is very simple. We will compare TT and TTB because both are important. For claiming TTA, you have to be a resident individual or HUF. Are you with me? You can claim what? TTA. It's not necessary that you have to resident, okay? It's not necessary that you have to be a resident for TTA. You have to be an individual or HUF, that's it. Whether resident or non-resident. And you have savings bank interest from banking company, cooperative bank or post office savings bank. Then you will get TTA, maximum 10,000. For TTB, they say resident plus senior citizen. Having FD or savings bank interest or recurring deposit interest, whatever deposit it is. We have three kinds of deposit. FD, RD, SB. RD means recurring deposit. FD means fixed deposit. Interest on savings bank means savings bank interest into. Then you will get a deduction and maximum it is 50,000. You claim TTB, forget about TTA. If you are eligible for a TTB, don't even think about TTA. I hope this much is clear. Next is 80U, that is already covered. What was 80U? You have disability. That is 80U. Apart from that, everything in that 125 for 80% or more, 75 in other cases, everything is same. Now the next is 80JJAA, that is deduction in respect of employment opportunity for new employees. So I want all of you to take notes on this because this looks very complicated. This looks very complicated. So I want all of you to take notes on 80JJAA. So please open your notebook and write the heading deduction under 80JJAA. That is deduction for new employment opportunities. 80JJAA deduction. Deduction in respect of employment of new employees. So listen, let's understand what exactly is this 80JJAA deduction. The first thing they say, eligible assessee. Eligible assessee. Eligible assessee should be a person having PGBP income plus subjected to tax audit. Subjected to tax audit. If you are a person having PGBP income plus you are subjected to tax audit, then only you are eligible for 80JJAA deduction. Are you with me? Now the deduction shall be 30% of employment cost. Employee cost, not employment cost, employee cost incurred. Employee cost incurred and can be claimed for 3 years. For 3 years. For 3 years in which such employment is provided. That simply means it's a super deduction. Listen friends, listen. I'll give you an example to understand this paragraph. Listen. Say for example, I'm a person having PGBP income and I'm subjected to tax audit. I'm an eligible assessee. That is the first thing that you should know. I'm an eligible assessee. Now listen. Being an eligible assessee, I have appointed, this is my first year of business. Are you all with me? This is my first year of business. I have appointed 100 employees. I have appointed 100 employees having a salary of 1 lakh per year. Having a salary of how much? 1 lakh per year. It's per year. How much is the total salary in a year for me? 1 crore. You don't require a calculator for that. Do you? No. 1 lakh into 100 employees per year, it is 1 lakh. So it will be 1 crore rupees. Yes or no? This 1 crore rupees I can claim as a deduction under 37. 37, section 37, other deduction. Yes or no? If it is a business expenditure, you can claim it as a deduction under 37 under PGBP. Yes or no? Now, for the same 1 crore, I can claim 80JJAA deduction as well. Department say, you take 30% of 1 crore as a deduction under 80JJAA. How much is 30% of 1 crore? 30 lakhs as a deduction under 80JJAA for year 1. Year 2, same I can claim 30%, 30 lakhs. And year 3, 30 lakhs. So department say you have employed certain persons. For that first year of employment, you claim 30% under 80JJAA. Second year of employment, you don't have to additionally employ anyone. For the first year employment itself, you take a deduction for year 2 also. For first year employment itself, you take a deduction for year 3 also. So totally, if you consider all these 3 years, how much is your total deduction? You get 1 crore in year 1. Alright? Then 1 crore salary in year 2. Because that is the salary paid by you. 1 crore salary in year 3. Along with that, you will get 30, 30, 30 in year 1, 2 and 3. From year 4, you will not get. Year 4, if you have appointed other new employees, you will get. You got my point? It is not for only for the first 3 years of an employer. It is not like that. It is for the employment first 3 years. You employed 100% and you are not employing additional employee next year, then no other deduction. If you are employing additional employee second year, then that second year will be the first year for JJAA. You employed someone in the second year, then that year, year 3 and year 4 you will get, because for an additional employment you will get deduction for 3 years. Provided that employee have to be there in all these 3 years, then only you will get the deduction. Are you with me? This looks a little complicated, but there's nothing. See, you have employed someone, very good thing, because unemployment will get over. For that, we will give you, make that person work for 3 years. We'll give you deduction for 3 years. In year 2, I've appointed someone else. Then from year 2 onwards, another 3 years for that new employment. In year 3, I've employed someone else also. Then that year 3, I will get a deduction for another 3 years. You got my point? Every year, I have additional employment. Every year, I can take 30, 30, 30 for the next 3 years. Are you with me? Super. Then point number 2. Not point number 2, next point. There are certain conditions that are required to be fulfilled. So let's understand which all are the conditions that are supposed to be satisfied. So listen, friends. Let's understand which all are the conditions. Let's write additional employee. Additional employee. Additional employee can be split into 2. Additional employee have to be split into 2. Split number 1, they say, in the first year of business. In the first year of business, every employees are additional employees. Subjected to limits. Subjected to limits. What do you mean by that, friends? This is your first year of business. All your employees are what? Additional employees. Yes or no? Say, this is my first year of business. All the employees are new employees, and hence I can claim the benefit of what? 80 JJAA for their salary, subject to certain other limits also. Now, in subsequent year, there should be an overall increase in number of employees. In subsequent year, there should be an overall increase in number of employees. There should be an overall increase in the number of employees in the subsequent year. Listen, friends, what do you mean by this? Say, for example, in year 2, year 1, according to the last example I've told you, I have 100 employees. Yes or no? Are you all listening? Year 1, I had 100 employees. Year 2, I terminated 10 and I appointed 20. I fired 10 and I'm appointed 20. So, year 2, my overall number will be 110. Because from year 1, I had 100. I've discontinued or fired 10, then appointed 20. Can I say that 20 additional employees? No. You have fired 10, then you appointed 20. Overall increase is only 10. So in year 2, additional employees only will be 10. You got my point? Otherwise, every employee, what they will do to take this deduction, they will fire. After these 3 years, they will fire the employees and they will appoint some other in the place of old employees. And they will say, new employment. Not possible. Department say, subsequent years also onwards, you should have an overall increase in the number of employee. Then only we will treat it as an additional employee. Otherwise, we will not treat it as an additional employee. I hope you guys are with me. Moving on with the next point. Under that, there are certain common conditions. Number 1, salary should be paid. Salary should be paid by way of account pay crossed check or account pay bank draft or electronic clearing system ECS or prescribed electronic modes. So what they say is salary should be paid by either account pay check or account pay bank draft or prescribed electronic modes or through electronic clearing system. If you have paid salary in any other mode, no deduction. No deduction for those payments. You paid something in this mode, something in other mode. Only those salary paid in this mode will be eligible additional employee cost, because additional employee cost 30% is your deduction. So take as additional employee cost, the payment should be in this method. Are you all with me? Are you all with me? Now, friends, there are a few more points that you need to consider. That is, the following employees are never considered as additional employees. There is a negative list for the definition of additional employees. So let's understand the negative list. We can say negative list. The following employees are never considered as what? Additional employees. Let's see which all are the negative list items under 80JJAA. So listen, friends. Listen. So the negative list, I will show it from here. So these are the negative lists. So listen. Exclusions from the definition. These are the negative list items. So number one, what they are saying is an employee whose total emoluments are more than 25,000 per month. That simply means if you are an employee earning a salary of 20,000 per month, more than 20,000 per month, not an eligible employee. Normal laborers are your eligible employees. You have appointed 10 new managers having a salary of 40,000 per month, not your eligible employee for the purpose of 80JJAA. 25,000 per month should be the maximum salary or below that. If it is more than 25,000, they are not eligible employees. Point number two. If government is paying the entire pension contribution of employees, then they are also not counted as eligible employees. In certain sectors, the central government, they themselves have taken the liability of paying pension. Alright, certain sectors are taken over by the central government. They themselves will directly pay the pension. If the pension contributions are taken over by the central government, those employees are never regarded as what? Additional employees. If in my factory, for certain class of workers, central government has taken the pension contribution. Employer is not paying the pension contribution. Central government is directly providing the pension contribution. Then that sector employees can be never called as additional employees. That simply means I will not get the deduction of 80JJAA for that class of employees. Are you all listening? Then an employee who is employed for a period of 240 days or less. An employee who have employed for a period of 240 days or less in a PY. Say in 22-23, I have appointed a person on 1st January 23. Then it will be only 90-91 days. January 31, February 28, March 31, if February is not a leap year. Then 90 days. If Feb is a leap, 91 days. Yes or no? That person is not my additional employee because he have to be employed for 240 days or more. Are you all with me? Now, not 240 working days, 240 days, because there will be Sundays in between. Not a problem. So when you hear 240 days, don't think Sunday, Saturday excluded. No. It's not like that. From the date of joining till the year end, if you can count 240 days, then no problem. Now, if you are in the business of manufacturing of apparel, what is apparel? Your accessories like your clothes, your shoes, your belt, your purse, etc. Or footwear, your shoes, chappals, etc. Or leather business. If you are in the business of apparels, footwear or leather, instead of 240, the limit is 150. Instead of 240, number of days that you have to employ an employee is 150. This is important. For a normal industry, number of days that you have to employ is how much? 240 days. For leather, footwear and apparel industry, instead of 240, it is 150 days. If an employee is employed for 150 days, then he will be an eligible employee. On his employment cost, you can claim 30% as a deduction. Are you all listening? Super. Then, next point. And if your employee is not participating in recognized provident fund, then they are not additional employees. Say, for example, article assistants, trainees, apprentices, etc. They will not participate in what? Recognized provident fund. They can never be treated as an additional employee. And finally, casual employees. That means temporary employees. Only for that particular demand, you brought some employees. Those employees are not your additional employees. So these are not additional employees. But there is a problem. There is a problem with this. Can you listen carefully? There is an issue with this. Listen. I have appointed an employee on exactly 1st January. Are you all with me? In the PY 22-23, how many days he have employed? Only 90 days. In the PY 22-23, he have been employed in my company only for 90 days. Then according to the theory what we have learned, he is not an eligible employee or an additional employee. You will not get deduction for his salary. Are you all with me? Are you all listening? Say in 23-24, he is not an additional employee. In 23-24, he may be employed for more than 240 days, but you cannot call him as an additional employee. Why? Because you have appointed him last year. This is an issue because every employees who are employed after the 240 days or 150 days will not be additional employee next year because you have appointed him last year. Last year he was not additional employee, so you cannot claim ATJJ last year and this year. To cope up with this, department say, if in the year of employment, a person does not cover 240 or 150, but in the subsequent year he covers 150 or 240, 150 for leather, footwear or apparel, 240 for others. If he is covered 150 or 240 in the next year, then he can be treated as an additional employee of the next year. According to this example, he will be treated as a new employee for 23-24 if he satisfies that 240 or 150 days condition. Yes, then for the next 3 years, you will get a deduction under ATJJAA. Excellent. Are you guys with me? Hope you got the concept. This is it. This is it. If you are appointing someone in the last year and he is not covering 240 or 150, depends upon your business. He will be treated as an additional employee subjected to a condition that he is covering 240 or 150 in the next year. In the next year, he will be treated as an additional employee and you can take deduction for the next 3 years. I hope it is clear. Let's see what exactly is the deduction under ATG right now. Deduction in respect of donations given to certain funds or charitable institutions, etc. Alright, so listen, let's understand who exactly is the eligible assessee here. So where an assessee pays any donation to eligible funds or institutions, that means under ATG, there are a set of eligible institutions where if you give donation to those eligible institutions, you can claim that donations as a deduction. Now, he is entitled to a deduction subjected to certain limitations from the gross total income. Who all can claim this? All assessees can claim ATG deduction. Irrespective of your citizenship, irrespective of your residential status, all assessees in India can claim this ATG deduction. Moving on. There are certain conditions to be satisfied for claiming ATG deduction. Condition number 1, the donation should not be in kind. What do you mean by kind donations? The donation have to be in monetary terms. Don't give any kind donations and claim it as a deduction. If the income tax department gives a deduction for the kind donations, then what people will do, they will give all the old things and they will start taking donations by putting some value. And department say, we won't give you any donation, we won't give you any deduction if you have donated in kind. You give it in the monetary terms to the specified funds or organizations. Now, donation in kind shall not qualify for deduction, as I've told you. Now, the mode of donation. Donation in excess of 2000 shall be made by any mode other than cash. So, if you are donating by cash up to 2000, you can donate. And if you are donating more than 2000, then it should be in any mode other than cash. You can give check or you can Google Pay it. Absolutely no problem. Don't give cash donations. So, up to 2000, you can give what? Cash donations and maintain vouchers. 2000 above donations have to be made in any mode other than cash. Moving on. Cash donation up to 2000 shall qualify for deduction. Now, the proof of donation in original should be attached with the return of income. So that means the voucher is important. Otherwise, everybody will claim deduction for ATG. Are you with me? The voucher is actually important. And there is one more thing. The donee have to be a registered entity. Then only you will get it as a deduction. I'm talking about the donee. Who's donee? The person to whom you are donating have to be a registered entity under ATG. Then only you will get this as a donation. Now, we can divide this ATG deductions into 4. We can divide this ATG deductions into 4. Number 1, donations qualifying for 100% deduction without any qualifying limit. You don't have any qualifying limit, you will get 100% as a deduction. Limit number 2 or item deduction or category number 2, donation 50% deduction without any qualifying limit. What do you mean by that? You give 100 rupees and take 50 rupees as deduction without any other limit. That is said to be 50% as a deduction without any qualifying limit. And category 3, donation where 100% is allowable as a deduction, but it is subjected to what? Some other qualifying limit. What is qualifying limit? I'll tell you later. Alright, I'll tell you later. Now, The fourth category is donation qualifying for 50% deduction, again subjected to qualifying limit. What is qualifying limit? I will tell you later. So there are four categories. Repeat with me. Which are the four categories? 100% without any limit, 50% without any limit, 100% with limit, 50% with limit. Done. Now, listen. The limit is applicable only on B category items. So forget about this. So let's understand which all are the categories first of all. Before that, let's understand what is this adjusted total income or what is this qualifying limit. Listen, according to ATG, qualifying limit simply means it is 10% of the adjusted total income. That means first you need to compute your adjusted total income. 10% amount shall be the qualifying limit. For category 3 and 4 only requires qualifying limit. Category 1 and 2 we don't require any qualifying limit. What is qualifying limit? It simply means you compute the adjusted total income, apply 10%, that will be your qualifying limit. What is this adjusted total income? That is the next question. Adjusted total income simply means you take the normal total income. Normal gross total income. What is normal gross total income? You compute income under 5 heads. Apply clubbing as well as set of provision. The combined figure is called as what? Gross total income. From that gross total income, you deduct. If in that gross total income, if there is long-term capital gain, you remove it. Long-term capital gain either under 112 or 112A. Whatever the long-term capital gain you have in the gross total income, you remove it. Then short-term capital gain accessible under 111A. What is short-term capital gain accessible under 111A? Listed shares, listed unit of equity oriented fund and listed unit of business trust. When you transfer the short-term capital gains is subjected to 15% rate of tax under section 111A. If that income is also there in the gross total income, you need to remove it. And what is next? All the deductions under 80C to 80U is allowed as a deduction except ATG items. Why except ATG items? ATG items is we are about to compute ATG items. Okay, so except ATG, you can claim all other chapter 6A deduction from the gross total income. Are you with me? Now, the next is you need to remove all the incomes referred under 115A, AB, AC, and AD. That's what we have learned. There is one more, etc. Instead of etc., we will use 115A, D as well. What is 115A? Rate applicable for non-residents. What is 115AB? For OFO. What is 115AC? That GDR, dividend income, etc. Then 115AD, specified funds, and for FIIs. Hope you remember. Alright. So, in inter-syllabus, this 115A, AB, AC, AD, etc. is not there. When it comes to the final syllabus only, we need to apply, we need to think about this 115A, AB, AC, AD. Are you all with me? Now, moving on. So, after deducting all these things, the remaining figure can be called as what? Adjusted gross total income. On that adjusted gross total income, you apply how much? 10%. And that figure can be called as what? It is called as the qualifying limit. Are you all with me? Now, while calculating adjusted gross total income, casual incomes like winning from lottery, etc. have to be included. You are supposed to deduct only 3 types of incomes. Long-term capital or 4 types of incomes. Long-term capital gain, short-term capital gain under 111A. Normal short-term capital gain will form part of the qualifying limit. Then, third one, which is the third one? It is all the incomes under 115A, AB, AC, AD, etc. Alright, there is no fourth one. We have combined everything under third one. 115A, AB, AC, AD, etc. Incomes, if it forms part of the gross total income, you need to remove it. And you can claim all the chapter 6A deductions as well except 80G deduction. Now, there are, as I've told you, there are how many categories, friends? 4 categories. Which is the first category? That's what we are about to discuss. So the first category means, number 1, National Defense Fund. Any contribution made to National Defense Fund set up by central government allowed as deduction without any ceiling limit, 100% without ceiling limit. Now we are talking about what? First category. What is the specialty of first category? 100% allowed as a deduction without any ceiling limit, without any qualifying limit. So the first donation is National Defense Fund. Second one, Prime Minister's National Relief Fund. Third one, Prime Minister's Armenia Earthquake Relief Fund. Then fourth one, Africa Public Contributions India Fund. Then National Children's Fund. Then National Fund for Communal Harmony. Then approved university or educational institution of national eminence. Then Chief Minister's Earthquake Relief Fund, Maharashtra. Then any fund set up by the state government of Gujarat exclusively for providing relief to victims of the Gujarat earthquake which happened earlier. Then any Zila Sakshatra Samiti constituted in the district for improvement of primary education in the villages and towns for the literacy and the post-literacy activities. Then National Blood Transfusion Council. Then state government fund set up to provide medical relief to poor. Then any Army Center Welfare Fund or Indian Naval Benevolent Fund or Air Force Center Welfare Fund established by the Armed Forces. Then Andhra Pradesh Chief Minister's Cyclone Relief Fund happened earlier. Then National Illness Assistance Fund. Then Chief Minister's Relief Fund or Lieutenant Governor's Relief Fund in respect of any state or union territory. Then National Sports Fund set up by the CG. Then National Cultural Fund set up by the central government. Then the Fund for Technology Development Application set up by the central government. Then National Trust for Welfare of Persons with Autism, Cerebral Palsy, Mental Retardation and Multiple Disabilities. Then Swachh Bharat Kosh set up by central government other than some spent by the assessee in pursuance of CSR under section 135 subsection 5 of the Companies Act. Under CSR also they are mentioning about the Swachh Bharat Kosh. It should not be that. Alright. Then Clean Ganga Fund. Then National Fund for Control of Drug Abuse. And finally, Prime Minister's Citizen Assistance and Relief in Emergency Situation Fund. It is also called as the PM Care Fund, and that is the most common fund. PM Care Fund, Prime Minister Care Fund. If you donate it to these 24 items, you will get it as a deduction without any ceiling limit or qualifying limit. But the problem is you have to remember all the 24 items, or there is one solution. What you can do is the other three categories are small. You can study all the other three categories and you can assume whatever else shall be subjected to full deduction without any ceiling limit. This is the tip that I want to tell you. It is better always to study everything separately. But to remember all these 24 items is like hectic. Yes or no? So what you can do is you can study all the other three. And you can assume that except all the other three, everything is subjected to 100% deduction without any ceiling limit. So let's understand the second category. What is second category? Donation qualifying for 50% deduction without any ceiling limit. You 100 take 50 as a deduction. So how do you take that deduction? Which all of the items comes under that particular bracket? Number one, Jawaharlal Nehru Memorial Fund. Number two, Prime Minister's Job Relief Fund. Then Indira Gandhi Memorial Trust and Rajiv Gandhi Foundation. You give any donation to these four, you will get the 50% of the donation as a deduction without any ceiling limit. And moving on to the third category. What is the third category? 100% is allowable, but it is subjected to 10% of the adjusted total income. That 100% should come under 10% of adjusted total income. Are you with me? That 100% should come under the 10% adjusted total income. Say for example, you have donated 1 lakh, but 10% of adjusted total income was only 80,000. Then you can take only 80,000 as a deduction. Are you with me? Now, which all are the items? Government or to any approved local authority or institution or association for promotion of family planning. Then some paid to the company as donation to Indian Olympics Association or any other association or institution established in India, as may be notified by the government for the development of infrastructure for sports and games or for sponsorship of sports and games in India. So these two items comes under donation qualifying for 100% deduction with subjected to qualifying limit. And to the last item under this, that is donation qualifying for 50% deduction subjected to again qualifying limit. And what is qualifying limit? Repeat with me. What is the qualifying limit? 10% of the adjusted total income. What is this adjusted total income? You compute the normal gross total income. Then you remove long-term capital gain either 112A or 112. Then you remove short-term capital gain under 111A. Then you deduct all the 80 chapter 6A deductions except 80G. Then finally you remove if there is any 115A, AB, AC, AD, if any. I hope it is clear. Then apply 10%. That will be the qualifying limit. Now the final item is qualifying donation qualifying for 150% deduction subject to the qualifying limit. Now, point number 1. To any institution or a fund established in India for charitable purpose fulfilling prescribed condition. You give any donation to a charitable trust, you will get it as a deduction under category 4. Only 50%, that too subjected to qualifying limit. Now, government or any other local authority for utilization of any charitable purpose other than the purpose for promoting family planning. Except for the promotion of family planning, if you are giving anything to a government or a local authority for utilization of any charitable purpose other than family planning protection or protecting family planning. Then point number 3, an authority constituted in India by or under any law enacted either for dealing with or satisfying the need of housing, accommodation, or for the purpose of planning, development or improvement of cities, towns, villages, etc. The town planning, development, etc. funds. And finally, second last item, any corporation established by the central government or a state government for promoting the interest of members of minority community. Those, corporation which is established for minorities. Then, item number 5, for renovation or repair of notified temples, mosque, gurudwara, church and other place of historic or archaeological or artistic importance, or which is a place of public worship of renown throughout any state or states. So all these 5 items are subjected to deduction, that to 50% subjected to 10% of adjusted gross total income. If you have contributed all 4, how do you compute deduction? That is the next thing. You have contributed deductions to the all 4, because when you are contributing, you don't know. For a common person, they don't know whether it comes under category 1, 2, 3 or 4. You have contributed everything. How do you compute deduction? Very simple. First one, 100%. Second one, 50%. Third and fourth, if you have, then how do you compute the limit and how to adjust it? So listen, steps for computing deductions where qualifying limit is applicable. That means these steps are there for the third and fourth category. The steps are there for third and fourth category. Listen, number 1, compute adjusted total income. That is the gross total income reduced by the items which we have already discussed. That means compute the adjusted total income. Calculate 10%. That means you need to compute the ceiling limit first. Ceiling limit first. That is your first job. Are you all listening? The first thing to do when you contribute anything to third and fourth category is to compute the ceiling limit. Now, what else? Then consider category 3 deductions which are eligible for 100% deduction. Then you consider the category 3 items first. Say for example, I have 1 lakh rupees as what? 1 lakh rupees as the qualifying limit. 10% of my adjusted total income came to how much? 1 lakh. The first thing I have to do, I have given third and fourth contribution. What was third one? Third item, 100% allowed as a deduction subjected to ceiling limit. Are you with me? Say I have given a third category contribution. That amount is 60,000. Then first I need to do is always consider the third category first. If I am contributing both to the third and fourth, first priority should be given to which one? Third one. So 60,000 I have contributed. So I've contributed 60,000, and how much is the qualifying limit remaining? 40,000 is the qualifying limit remaining. Yes or no? Then what to do? Then thereafter 50% of the balance qualifying limit shall be eligible for the deduction. What do you mean by that? Say for example, and I've donated 50,000 rupees to category number 4. I've donated what? 50,000 rupees to category number 4. So that category number 4, what is the speciality? First of all, it is subject to ceiling limit. Then you will only get 50%. Which one to apply first? Whether the ceiling limit or 50%? You have given 50,000. First thing to do is whether that entire 50,000 can be accommodated by the balance limit you have. What is the balance limit you have as per this example? 40,000. Yes or no? So you take the entire 50 that exceeds the total balance available in the ceiling limit. Yes or no? So even if you contributed 50, you can only treat 40,000 as your contribution. Out of this 40,000, you apply 50%, and hence you will only get 20,000 rupees. It is not like out of 50, you apply 50% first, 25. Whether 25 comes in that bracket or not, it is not like that. First, you check the ceiling limit. Are you with me? I've given 50,000 and the balance ceiling limit was only 40. So I can only take up to 40. That too, 40 is 50%. Have you got it? Say for example, instead of this, say my balance limit is 80,000. Say my balance limit is 80,000. I've contributed 50,000. Then that entire 50,000 can be accommodated because I have that much balance. Then out of that 50%. That means 25,000 I can claim it as a deduction. I hope it is clear. So these are the steps to compute what? Deduction when you have made a category 3 and 4 contribution, and that's it. Okay friends, now please take question number 7. It's in page number 36. Question number 7, it's in page number 36, and go through the question and give me the answer. Alright friends, so let's go through this question. Let's read this question together and let's find out the answer. So listen, what they are saying is Shiva, aged 58 years, has gross total income of 7,75,000 comprising of the income from salary and house property. He made the following payments and investments. So his GTI. So how much is his gross total income, friends? Gross total income is 7,75,000 rupees. Yes or no? Now, he has made some investments, etc., etc. Let's discuss all the investment first. Now, the first item is premium paid to insurance to insure the life of her major son, and policy taken on policy taken on 1/4/2019, and assured value is 1,80,000. Are you all with me? So what to do with this? Under 80C, according to 80C that we have learned, if the policy is taken after 1st April 2012, then the maximum deduction for the premium shall be 10% of the sum assured. And how much is the sum assured? 1,80,000. 10% of the sum assured shall be 18,000 rupees. Hence, you cannot claim deduction for the entire 20,000. Out of that, you can claim only deduction for 18,000 rupees. Are you all with me? So what I can write is, under section 80C, life insurance premium that we have paid is how much? Paid is 20,000, but you can claim deduction only up to 18,000. I hope that is clear. We have already discussed 80C deduction. Now moving on to the second one is medical insurance premium for self, that is 80D. To be very precise, which category? Category number 1. And spouse 14,000, that is also category number 1, because you yourself and your spouse comes under family definition. Are you all with me? So how much is the total? 12 plus 14, that will be 26,000 is the total, but maximum deduction under category 1 for a person who is not a senior citizen shall be 25,000. So you can claim only up to 25,000 rupees as a deduction. Hope you remember, because we have already discussed 80D. Now 25,000 is the 80D deduction. So I will call it as 80D. Under section 80D, amount is 25,000. You can claim it as a deduction. Moving on with the next item, donation to public charitable institution registered under 80G. That we will deal later, because we have to compute the adjusted total income and other things. So we are leaving it like that, but we will discuss it later. So let it be there. Now next is LIC pension fund is under section 80CCC. If you are contributing anything to pension fund maintained by LIC, you can claim that contribution as a deduction under 80CCC. And hence I will write 60,000 as a deduction under 80C. So this is under section 80CCC. Under section 80CCC. How much is the amount, friends? 80CCC, it is 60,000 rupees. Let it be there. Now, what about the next one? Donation to National Children's Fund. Let it be there, because it is an 80G item. Let it be there. Donation to Jawaharlal Nehru. Let it be there. Donation to approved institution, let it be there. Donation or deposit in PPF, what to do with that? Public Provident Fund deposits are subjected to a deduction under 80C. So PPF, that is PPF donation. How much is the PPF donation, friends? It is 1 lakh. Now, first of all, under 80C, we have a ceiling limit, that is 1,50,000 is the maximum deduction that you can claim. Here, adding both, it is only 1,18,000 rupees. So that is definitely deductible. Now, there is a section called 80CCE in income tax. What 80CCE says is 80C plus 80CCC plus 80CCD subsection 1 should be always less than or equal to 1,50,000. This is 80CCC is here, 80C is there. Adding these two, how much is the total figure coming? 178 is coming. But can you claim this entire 178 as a deduction? No. The maximum deduction allowed from this shall be 1,50,000. And you can claim this entire 25,000 as a deduction under 80D. For that, there is no other restriction. 25,000 as a deduction under 80D as well. Now let's deal with the 80G items. Now let's deal with the 80G items. So listen, for the 80G items, let's discuss each and every 80G items, friends. So which is the first 80G item, that is a donation to a public charitable institution registered under 80G, that is 50,000 by way of check. A public charitable institution comes under which category? A public charitable institution comes under category number 4. Let it be there. First, we will write the categories. The next one, donation to National Children's Fund comes under which category? First category. So, category 1. That we can, right now itself we can deduct because it does not have any other ceiling limit or something. So, we can deduct that particular item. That is 25,000 and you have to check the mode of payment by way of check. It is fine. Because all the payments over and above 2,000 have to be made other than cash. So 25,000 you can claim it as a deduction. So I'm writing, or we will do a working note for 80G. Working note for 80G. So the item is National Children's Fund. The amount is 25,000 fully deductible. Alright. Now what is next? Next item, what they say is, listen. Next item is donation to Jawaharlal Nehru Memorial Fund. You tell me Jawaharlal Nehru Memorial Fund will come under which category? Second category, 50% without any ceiling limit. So we can deal that because it does not have any other ceiling limit. So it is under the second category. So 25,000, that means 12,500 you can take it as a deduction. Yes or no? So it is Jawaharlal Nehru Fund. We will call it as Jawaharlal Nehru. When you write, you need to write in full Memorial Fund. Now 25,000 half means 12,500 is allowed as a deduction. Now, next is donation to approved institution for promotion of family planning. It is under category 3. So, we have all the categories. Yes or no? So, category number 3. Category number 3 is subjected to what? Qualifying limit. So, we have 3 and 4 to deal with. We have 3 and 4 to deal with. Yes or no? Before dealing with category 3 and 4, you have one duty. What is that duty? You need to compute the qualifying limit. What is qualifying limit? You compute the adjusted total income, then apply 10%, then you will get the qualifying limit. What is adjusted total income? For that, you need to take the gross total income first. So, let's compute the adjusted total income now. Adjusted total income now. For that, you need to compute the gross total income first. You don't need to compute, that is already given in the question. How much is the gross total income? 7,75,000. 7,75,000 is the gross total income. From that, you can claim all the allowable deductions from 80C to 80U. In this question, they are not mentioning about long-term capital gain or short-term capital gain under 111A or 115A, AB, AC, AD, etc. So, we don't have to consider that. The only one thing that we have to deduct is chapter 6A deductions apart from 80G. Yes or no? So, which all other chapter 6A deductions apart from 80G? 1,50,000. As per 80CCE, 1,50,000 is there. 1,50,000 is there. Then you have 80D item 25,000. So tell me how much is the adjusted total income coming? Just help me with the figures. It is 6 lakh. Adjusted total income coming is 6 lakh. Now you can apply 10% of adjusted total income as the ceiling limit. And how much is the ceiling limit? 60,000. 60,000 is the ceiling limit. 10% of the adjusted total income is the ceiling limit. That will be 60,000. Now, you have 3 and 4. Which one to take first? 3, because you will get 100% deduction. So, you should give priority to 3 first. What is the third category deduction? Third category, it is donation to approved institution for promotion of family planning. 40,000 is the amount. So, you can claim that entire 40,000 as a deduction. So, approved institution, which is under category 3, full 40,000 you can claim as a deduction. If you claim 40,000 as a deduction, how much is the balance ceiling limit you have? You have only 20,000 as the balance ceiling limit. Yes or no? In exam, you can compute it like this. You can write a separate column for that. And how much is the balance? 20. Now you check whether the category 4 donation can accommodate, whether it is coming under this 20. Category 4, you have given 50,000. Yes or no? Your balance is only 20,000. You take the balance 20 and you apply 50%. That means effectively how much you can take? 10,000 is the effective deduction. Are you with me? So follow this. Listen. If you didn't get it, listen again. Once you compute the ceiling limit, then give priority to category number 3. You deduct category number 3 deductions from the ceiling limit. How much is the balance? If the balance, listen, if the balance is more than category 4 deduction, if balance is more than category 4 deduction, you can take that entire category 4 into 50% as a deduction. If the balance is more than category 4 deduction, then you can take the entire donated amount as a deduction and apply 50%. But if your balance is less than the category 4 donation, that is what the current scenario is. Your balance is less than the category 4 donation. So what to do? Take the balance, apply 50%. Are you with me? This is the easy formula that I can tell you under 80G. So take the balance, and the balance is, here the donation amount is how much? Actual donation that you have given is 50,000, but you cannot take that full. Why? Because you have 20,000 only remaining. So you need to take only 20,000, then apply 50%. That will be how much? 10,000 as the category 4 donation. You take the total. How much is the total? 25 plus 12.5 plus 40 plus 10. How much is the total coming? 87,500 is the total figure coming. Now you can apply this 80G deduction as 87,500. So if you apply this 87,500 as an 80G deduction under 80G 87,500, then sorry, not here. You need to write it outside. 87,500. Now you tell me how much is the total income after all the deductions. Total income after all these 3 deductions shall be how much? 5 lakh. From 775, deduct 1 lakh 50, 25 by 87,500 will be 5 lakh. 12,500 is the taxable total income. I hope it is clear.
To purchase recorded lectures and textbooks, visit our website www.cajoscurian.com.